We've revised our growth rate for Germany down from -1% to -4% next year. Mark Wall, our chief economist for Europe, as you say, put out a very nice piece this morning indicating the spillover from Germany and the rest of Europe being somewhat affected by the gas cutoff is enough to certainly put us in recession. Now that is a modest negative for the U.S., but it's certainly not enough to put Powell off course at this point. The inflation problem is going to be there. It's going to continue, and this tight labor market continues until we see some real slowdown in the U.S.
Peter, I guess that I'm trying to gauge the depth of the recession that you see in the United States. You do say a 5% NAIRU neutral interest rate. You also are looking at unemployment for above 5%. Do you have a sense of the duration, not only of how long rates will stay there, but also of how long we will be in a negative growth, higher unemployment kind of environment?
Well, we expect growth to slow noticeably in the first half next year. I mean, part of what's happening here is we've seen this rotation of spending from goods where production was ginned up substantially. Now that's shifting over to services. Inventories are running up. We're going to have to see some inventory adjustment first half next year, which will certainly begin to slow things. Then we think that this war chest of savings that the house is supporting the households will begin to run down enough for consumer spending to begin to slow by the middle of next year. We're anticipating negative growth for the second half next year, -3.5% at an annual rate in the third quarter. Another negative, not quite as deep, in the fourth quarter, and then beginning to come back in 24. So it's a relatively moderate, relatively brief recession. The Fed begins to reverse course on its rates because that slowdown is going to help bring inflation down and allow it to reverse course, something that's not in its current forecast at this point.
Peter, is the recession spread evenly across America? Does a certain part of the public face the Deutsche Bank recession call and others can escape its grasp?
Well, it's always a way, if you will. I mean, there are wide range of income distribution, and certainly lower income households are going to be hit harder. Will be hit more on the job front. That's the unfortunate part of this. But I think, given the recession is going to be consumer-driven, it'll tend to be more broadly based than something that's initially a big housing crunch. But yes, this will be a broad-based recession. It's not going to hit all.
Some big calls in there, Peter. Fantastic to read the work of Deutsche Bank over the last few weeks. In fact, for most of this year. Peter Hooper there of Deutsche Bank Securities. Tom, that call on NAIRU being somewhere close to
stunning
5%.
Right.
I wonder where the Fed is on that and what it means for their unemployment projections that ultimately need to factor in higher unemployment to get inflation lower. If he believes it's close to 5, there's a lot of work to be done.
It's not the NAIRU jacket of another time and place. NAIRU, and all you need to know is the first two letters are non-accelerating. It's the quiet point is calculated with some unobservable data points, John. It's something people enjoy flunking on economic exams, but it's the quiet point you have to get get the slowdown done, and to have it above 5% is something a huge body of people have never experienced.
I wonder where that leaves their forecast, Tom, because year-end the Fed's got unemployment at 3.7, 23 at 3.9,
yeah, they're gonna
24 at 4.1.
They don't have the luxury of young Luzetti of UCLA and Deutsche Bank. They've got to spin a message, if you will. And this is true of every single institution, folks. They've got to spin a message that's appropriate and gradual, where with Deutsche Bank, there's a suddenness to it.
And those forecasts are set to be updated, Lisa, a little bit later this afternoon.
I want to see what they are. I especially want to understand how high they expect to have to go because of the resilience in the economy. And every different analyst who I've spoken to has said that right now this economy has been able to withstand higher rates better than so many people had expected because companies had termed out debt, because individuals hadn't taken on as much debt, because people had locked in fixed rate mortgages. all of these things that make it a less easy transmission of monetary policy, forcing the Fed to go further. How are they going to recognize that, and how that's going to force their hand with a lag effect that we can't really see right now?
They are the two major questions right now. How much higher rates need to be to bring down growth, and how much lower growth needs to be to bring down inflation. That's going to be a key feature in the conversation around the Federal Reserve a little bit later, and a key feature of our conversation with the former Vice Chair Richard Clarida, joining us straight after the Fed decision. And then he's going to stick around for the news conference, which I just think is incredibly cool. He's going to catch up with us after the news conference with Chairman Powell and break what he thinks down is going on, Tom.
Well, it's going to be fascinating. What an honor to have him here. He's the academic from Columbia with massive monetary chops. First question for me, John, is to know, are they making it up as they go?
You will get the first question. Up 0.2% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third meeting in a row, policymakers are expected to raise interest rates by 75 basis points. That would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. The special master in the Donald Trump documents case is skeptical of some of the former president's arguments. Federal Judge Raymond Dearie pushed back on the Trump lawyers' position that they didn't need to detail any alleged declassifications of highly sensitive records. He said the Justice Department had presented evidence that several of the documents were classified. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The difference between missed opportunity and actionable intelligence. For For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
We saw such high increases due to speculation over the geopolitical situation and some of the other issues that we're now seeing a kind of backing off of that. I mean, I think $120 a barrel was too high for the supply-demand situation, and so we're seeing that back off.
Brilliant to catch up with Ellen Wald, Senior Fellow at the Atlantic Council, live from New York. This is Bloomberg, counting it down to a Fed decision with equity futures just about positive, up a third of 1%, call it that, a quarter of 1% on the S&P, up a tenth of 1% on the Nasdaq 100. Yields lower by a couple of basis points, 353.77. Euro weaker, euro dollar negative a half of 1% to 99.26. I can tell you the Swedish currency is getting absolutely battered again for a fifth straight session, weaker against the US dollar. Might sound left field, but just give me a second, Tom. The Riksbank out yesterday with a 100 basis point hike, and we're still getting currency weakness. Vasilios Giannakis of Citi published just moments ago, and he said a continuation of the sell-off in risk assets due to the Eurozone's strong economic headwinds and the Fed's tightening path will maintain significant pressure on both the Norwegian currency and the Swedish currency as well against the dollar. And many of these central banks, Tom, they share the same concern at the moment. It's going to be the Bank of England's turn tomorrow, hiking into a slowdown and struggling to get any traction in the FX market.
I have to look the paper up, John. It's a good 25 years old, a brilliant paper from, I believe, the Peterson Institute. And, John, it's about watching 30 and 40 currency pairs at once. That's a little hard to do, but there is a value to looking at Nakistaki or at dollar, Swede, and the rest. I mean, you've got to look at all these pairs dynamically to have a guesstimate of where we're going.
There's a similar experience at the moment, Tom, against the US dollar, that's for sure. And certainly for the Federal Reserve, it's not their problem yet, it's everybody else's. I just wonder, Tom, for how much longer that might be the case.
For those of you unfamiliar, DXY is the core and ancient index. Bloomberg Dollar Index is better math, 110.57 on DXY is a shock, and particularly a shock to the nations of commodities. Kona Hake joins us now, head of research at ED&F Man, and is just brilliant on the soft, something we don't talk enough about. Kona, the impact of a strong dollar on commodity nations, commodity EM, how large is it?
Huge, huge. I mean, if you think about only 6 months ago when the war began in Ukraine, everything went up, whether it was energy, grains, they all went up. And that was because it was highly inflationary. But then the inflationary story in the US led to a higher US dollar. That US dollar then caused that whole commodity elevation to just come collapsing down. And now we're back to pre-war levels. So yeah, the dollar impact on commodities is very intact, and inverse correlations as intact as ever.
My training is to always pivot to Indonesia and Brazil on dollar strength. Are they of interest?
Well, yes, Indonesia, obviously, palm oil, massive producer of palm oil, exporter, and coal as well. And for Brazil, I mean, particularly for the soft commodities, you cannot underestimate the impact of the Brazilian real on all of these commodities. So what we're seeing today is the strong dollar is causing BRL to weaken. That in turn is putting pressure on things like coffee, sugars, soybeans, all the major Brazilian exports, iron ore even. But it's not just that. I mean, I think today commodities are reacting. They were positive initially because of the inflation story, but now they're coming off because the inflation story has moved to a recessionary story. And obviously that's not great for commodities, worse for metals and energy, arguably less so for softs, but it still is it does have a dampening effect for sure.
The focus still very much on the energy story, especially for Europe as they face off with a potentially catastrophic winter, depending on the meteorologist reports that we get. I'm wondering from your perspective, if the answer is what Germany is now doing, which is to nationalize energy companies, does that help support things in a more concrete way, or does it just basically put a Band-Aid over the actual bill that some of these countries are facing?
Yeah, so I think, in my opinion, it's a Band-Aid because the reality is that none of this is providing additional supply. So we have a supply-demand mismatch right now in the energy crisis. So we either tackle demand, so you have to ration demand, and I can't see Germany effectively rationing the demand. And certainly in the UK, they're actually, in effect, subsidizing the demand. So that doesn't even tackle that side of things. And on the supply side, I don't see them investing or allowing more natural gas to come out. So I don't see this as fundamentally altering the situation too much. And I think this can go on for a while.
Well, when you say this can go on for a while, there is a question of how much has already been priced in terms of what is to come for this winter. And then there is a question, as John's highlighted many times, of the duration of how long, how many years we face off with this lack of supply in the face of demand. What's your view on both of those?
So with time, humans are very innovative and markets are adaptive. So with time, what's going to happen is as long as prices continue to provide this pain pressure, you will start seeing adaptation. So you will move towards alternatives, renewables, you will become more efficient. So that's definitely something that will happen with time. Overnight, you're not going to get that. So I think effectively what we're saying is we need that pain pressure to continue for a little bit more to materialize these kind of actions. Only then will we start seeing a proper diversification, both in terms of demand and also supply. So we can start relying less on natural gas, relying less on Russia, even relying less on LNG. I mean, I'm understanding that the LNG carriers are, the freights are going through the roof. They're struggling to get hold of ships. So it's a multitude of problems that are not going to be fixed overnight.
And this is going to take a while. Kona Hag there of ED and FMAND. Thank you, Kona, as always. Several winters maybe, Lisa, perhaps even longer. And for many officials in Europe, I think that's the reality they've got to confront.
The problem is that each nation has its own energy situation, its own energy crisis. It's completely different. So how do they come up with a cohesive plan, especially when you have such differing political interests heading into this winter? It's really complicated, and you're seeing that expressed in the euro.
Bit of home bias for me, I know, but I find the UK situation fascinating, Tom, to see what this new Prime Minister's going to do in the UK and this new Chancellor as well.
Yeah.
They're planning some very interesting things. A lot of people are worried about housing prices at the moment, and they're now looking at cutting a transaction tax when you buy a house, Tom. So let's see what happens there.
They seem little, and they're sort of sprinkling them out, of course, off the shock of the death of the Queen and a new king and a new government as well. But John, a pregnant question here. Does she have the support of her party?
Does she have the support of the country, Tom? I think that's the big question. I think she's got the support of her party right now and the party membership. Okay. If that went to a general election, would she get the mandate to do the kind of things that this party's going to do, Tom, in the coming months?
Let's frame it as we did with Peter Hooper. EM decline. This is not year to date, but very close. I took it from the peak here in January or February. ADXY down a good amount. JP Morgan Emerging Market Index down as well. They're down 8 or 9%. And then, John, there's the emerging market of the United Kingdom down, I believe, 17%.
Having a very difficult time year to date, that's for sure. Futures positive. Let's call it 0.25% on the S&P. On the Nasdaq, up 0.1%. A Federal Reserve decision just around the corner, and they're set to hike interest rates again by 75 basis points. From New York, this is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price. And then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
City. Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this
How
story.
How are you thinking about those dynamics?
We're going to see tightening through the back end of the year, into the middle of next year, and then quantitative tightening, QT, continues in the background.
It's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with the economy slowing.
There is some thought that we're getting to peak hawkishness, but that's not going to move the market now.
The bigger risk and tail risk aspects are going to be really European energy crisis and how midterm elections go this year.
I do think the slowdown could be more significant than many economists are expecting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
One more big rate hike just around the corner, perhaps even more than that. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive, 0.25% on the S&P. TK, the consensus view, another 75 coming right up.
And there it is. And then what will happen after that? And as Peter Hooper of Deutsche Bank told us, this is just to neutrality. This is not a restrictive Wednesday. You may get that in the last two meetings of the year. But I think, John, all agree that even with this move today, we're nowhere near finished.
And then we get the forecast, Tom. Will they forecast the risk of a hard landing in the U.S. economy?
No, they will forecast in a measured, gradual way. They are a public institution, and their number one, they'll never say it, but their number one goal is to control the message and not instill fear. They're not going to go to the fear that we see from so many houses.
Elisa, the chairman, talked about that pain in his Jackson Hole speech. He talked about pain that might have to develop to get inflation back down. Will they capture some of that pain in that summary of economic projections?
That's going to be something people are looking for the credibility of the Federal Reserve, not just for the United States. I'm curious if they reflect the pain being felt around the world, how they're gauging the international influence on the United States. When they start to care about the dollar, they're probably not going to talk about that. But that has to be a niggling point on the outskirts of Jay Powell's mind, considering some of the pushback that they've gotten from the likes of the World Bank and the IMF.
Bank of England tomorrow, Swiss National Bank tomorrow. BOJ convening as well at the moment. Lisa, tough spots for them, those three, and maybe more so for the BOJ.
How about this for signaling? They actually engaged in an unannounced bond purchasing program overnight to support the yield peg where it is. You haven't had trading in Japanese bonds for 2 days. The first time that's happened going back to 1999. It is not a market. They are doubling down. And it's sort of surprising to me the yen hasn't given away to new weakness. But Tom's right. We were talking about this earlier. He said, people are scared to go against the Bank of Japan, to go against Japanese resolve to keep things where they are and potentially upend everything if they change that. But right now, wow, what an outlier and what a ticking time bomb.
That really is stat of the day, Tom. 2 days that the Japanese 10-year government bond has not traded for 2 days.
To translate this for non-sophisticates, they are doing a theory. It's no different than what China's doing with COVID. They've got a theory, but there's no published background. Richard Clarida, John, in all of his studies at Illinois and onto his excellence at Columbia, never has read a paper that shows that theory can work.
On market central planning. Let's see how it works out. Futures positive 0.25% on the S&P. Good morning to you all. Counting it down to a Fed decision with futures on the NASDAQ up by almost 0.1%. Yields lower by a couple of basis points to 353.97. That has not been the trend. It's been yields higher, yields higher, yields higher on a 2-year. Lisa, we came very close to 4%.
People really expecting a lot from this meeting, but also beyond. And that is a reason why the dot plot might matter to some people, why it could move markets significantly at a time when people want to understand, is this Federal Reserve moving close to the Deutsche Bank projection of potentially close to 5% neutral rates or end rates for the Federal Reserve? All right, at 10 a.m., bank CEOs, including Jamie Dimon of JP Morgan and Brian Moynihan of Bank of America, are heading to the Hill. They're going to be testifying before the House Financial Services Committee. A lot of theater. Curious to hear what they say about inflation, how it's affecting consumers, consumer lending. Are they getting more restrictive in how often they are lending, considering the fact that potentially people are going to have a harder time paying it back in the face of higher prices for basic day-to-day costs? Today is day 2 at the UN General Assembly. Traffic is completely clogged up in New York City. President Biden will be speaking at 10:30 a.m. And then he's going to be meeting with UK Prime Minister Liz Truss at 1:15 p.m. Curious to hear how that meeting goes, not just because of some of the tensions with respect to Northern Ireland, as well as U.S. British trade policies, but also, does he push back about some of her fiscal policies? Does he address what she's doing? Is there some sort of coherence with the U.S. support of the United Kingdom heading into also a potentially difficult winter? And at 2 p.m., this is the main event, the FOMC rate decision, followed by a press conference by Fed Chair Jay Powell. A lot of questions. You were talking about, John, whether he's going to acknowledge some of the weakness that may be required, according to some people, if we get inflation down or for getting inflation down. I'm watching the dollar. we're looking at a dollar that is the strongest going back to 2002. Yes, this is a Euro story. Yes, this is a British story, but this is also very much a Federal Reserve story. When do they start to care about this as not a positive in reducing imported inflation, but a negative, John, because what it does to the rest of the world will eventually rebound in some form on U.S. corporations as well as just generally the U.S. economy.
I've been enjoying the daily traffic report. Will you continue that?
Do you want that?
Sure.
I mean, if we really keep going with
Daily
this,
traffic ran on New York City.
You have, definitely barriers on all the roads.
That's their barriers.
Dumpster trucks, Tom.
John, I got out the Bentley let me out 8 blocks away from our office here in Midtown. And the police stopped me, and of course I had a tantrum. I said, "Do you know who I am?"
I said no.
I did the whole thing. They put me in the police car, drove me out to the George Washington Bridge, and said, "Walk."
See you later.
See ya.
Do you know who I am?
Do you know who I am? That's such a TK thing
I'd never
to say.
been up by the George Washington Bridge. It's beautiful.
On the way to New Jersey, Tom?
Yeah, except I had to walk back to our office here. I got my
Did you have a look at
exercise.
Englewood Cliffs?
I did. I waved.
What's it like over there?
Okay, guys.
I'd never been up there.
They talk about the Dow a lot on that
Okay,
side of the bridge.
all right. Oh, my goodness.
No, they do. I've heard they do.
I know.
I've heard they talk about the Dow a lot on that side of the bridge. I've got no idea why. Futures are up on the S&P by 2/10.
Dow futures up 70.
Laurie Heinel joins us now, Global CIO for State Street Global Advisors. Laurie, 75 expected today. That's what you're looking for. Can you guide us to November? Do you expect to get that guidance today?
Well, it's going to be hard to define what November brings because the Fed continues to be really focused on the emerging data. So I think that they're going to keep their cards close to their vest. We think that 75 today is almost a certainty, and we actually do think that 50 is more likely through the balance of the year. But the problem is that as long as they keep seeing this intractable inflation pressure through the data, they will be compelled to act more decisively.
Laurie, where do I hide? I mean, State Street is such a fabulous institution on sector analysis, factor analysis, diversifying into subsets, and what not to do. Where do I hide if I'm worried about what not to do right here?
Well, the best place is cash. And for the first time in many, many years, cash is actually giving you a bit of a return. So in our globally diversified portfolios, we've actually taken that cash position to about 10%.
Wow.
But interestingly, we're not just taking it out of equities, we're actually taking out of bonds as well. So we're a bit more balanced in where we're underweight.
Laurie, can we develop that a little bit more? Which bonds? Are you talking about duration, 10-year, 30-year Treasury yields, because you see those yields even going higher from here? Or are you talking corporate credit in the face of some sort of downturn?
Yeah, actually much more focused on corporate credit and being a bit underweight there. We're sort of neutral duration, curiously enough, but it's a bit more barbelled. So cash plus long duration, because we actually are concerned that we will have a much more aggressive Fed and that will create a much more contractionary or even recessionary environment. That, again, is not our core call, but we're positioned so we have a little bit of optionality if we're a little bit off on that.
Laurie, away from your remit, but let me go there to the income statement. Are there dynamics that can trouble us down the income statement at earnings or free cash flow, or is this really about a diminished revenue story?
Well, at this point in time, we don't feel like corporations are necessarily under pressure. They've got relatively large caches of cash. They actually are navigating the inflationary environment pretty well in terms of being able to pass on some increases to consumers, being able to reconfigure their operating models and things of that nature. So and oh, by the way, in the high yield indices, especially, we could actually be on the verge of some upgrades because we had a lot of downgrades as we headed into COVID. So they're actually, the fundamentals there are not particularly prickly. The problem is until we know what terminal rates are on the Fed posture, it's hard to know how to discount those future cash flows.
Is the equity market until then just totally unbuyable? The reason I ask this, Laurie, is it just seems to me every time we rally, get a host of people that say this is not the Fed, not what the Fed wants. They want financial conditions to remain tight and we're capped here. The Fed put is now a Fed call. Laurie, when does that change?
Well, curiously enough, and I was a little surprised to see this as well, we've actually seen net inflows into equities. So you still have had people dipping in, buying the dips. Perhaps some of it's rebalancing because, of course, equities and bonds have been down, but equities have been down more. But it's also a little bit of this fear of missing out again, because what we all know is that at some point, markets become leading indicators future economic growth. And so if we do have a recession or a contraction, at some point we get past that. So it's still a very unsettled market, and the range of outcomes is quite large.
Laurie Hano there at State Street. Laurie, one of the best. Thanks for being with us. Thank you very much. Lisa, that's the problem a lot of people have with this market. I remember David Costin at Goldman Sachs coming into the summer, who basically just said, we'll be capped here through the summer. The Fed's told you the playbook. They want tight financial conditions. That means an equity market that can't rally too much.
I hear that Neil Kashkari has been watching that very closely. And
Well, Neil basically said quite a bit out loud, didn't he, on that podcast, Odd Lots, with Joe Weisenthal and Tracy.
He basically said, look, we actually would be happy to see stocks sell off a little bit more. Will we get the same kind of message from Jay Powell today? Does he comment on financial conditions accurately reflecting or perhaps not reflecting as much what they're hoping to achieve?
Can I just suggest as a fossil that if you get rates back to where they are, and as Nassim Taleb said brilliantly in the last number of days, it's, you know, what we've been living is physics without gravity. And we're finally back to gravity, some form of risk-free rate. John, can I suggest life goes on? Like, you know, rates go up and people adapt and adjust.
I'm with you. We talked about adapting and adjusting yesterday.
Did you?
Just because you weren't here, so we thought we'd bring it
Well,
up.
you know, there were so many world leaders lined up at Gatwick, I couldn't get out with a
Adapting and
Gulf
adjusting.
Stream. Yeah, I
go to
couldn't get
Gatwick.
out.
Gatwick. I'm not a big fan of Gatwick, Tom.
I'm not either. The
Not a
drive
big-
was
not a
appalling.
big Gatwick fan.
I mean, I had 3 cars with me, but
Never have been. You took a motorcade to Gatwick.
Yeah, well, you know, the surveillance motorcade.
Sun goes up, sun goes down.
Companies adapt. Mike Wilson's going to talk about that.
We adjust.
Oh, yeah, I'm sure.
He's going to adapt and adjust his schedule and maybe delay the interview. He's going to join us in 50 minutes, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin declares it a fight to the death with the U.S. and its allies. He is calling up 300,000 reserve troops in a major escalation of the war in Ukraine. Putin also hinted at the use of nuclear weapons. He said that the U.S. and its allies want to destroy Russia. A Ukrainian counteroffensive in the last few weeks has dealt Russian troops their worst defeats since the early months of the conflict. The Federal Reserve is poised to raise interest rates today to the highest level since 2008, and it's likely to forecast that there will be another increase. Now, for the third straight meeting, policymakers are expected to raise rates by 75 basis points. Fed Chair Jerome Powell is expected to stress the Fed's resolve to curb inflation that's near a 40-year high. The Bank of Japan is trying to cap upward pressure on yields before a policy decision later this week. The central bank announced an unscheduled bond buying operation. BOJ Governor Haruhiko Kuroda has emphasized his determination to maintain rock-bottom interest rates, even though many other developed nations are increasing them. It's the latest foreign takeover of a British tech company. France's Schneider Electric has agreed to buy out minority shareholders in industrial software company Aviva Group. It's a deal that values Aviva at $10.8 billion. Schneider already owns 59% of Aviva. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So You've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Policy regarding China and Taiwan has not changed. We adhere to the one China policy. Having said that, we are concerned about China's stated ambitions, coercive behavior, and there is no reason to threaten Taiwan in the way China does.
A fantastic conversation with Jens Stoltenberg, the NATO Secretary General, and Bloomberg's Anne-Marie Hordern. Live from New York City on this Fed Decision Day with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures are positive 0.2% on the S&P. On the Nasdaq, basically unchanged now. Yields come down about 2 basis points, 354.36. Dollar stronger, much stronger in G10. Euro dollar negative 5 or 0.6%. Just about holding on to 99 now, Tom. Euro dollar 99.16. That euro weakness this morning off the back of some strong words from the Russian leader.
Yeah, euro weakness really critical. Lisa picked this up. I missed it, to be blunt. 0.9916. Anything under a 0.99 is a huge deal, and we are there. We'll continue to monitor that. Again, the VIX 27 showing 24 to 27 in the last number of days tension. We will continue now on Russia and on their leader. Anne-Marie Hordern joins us here as we just simply rip up the script. And I do saw Anne-Marie in February announcing my book of the year, which was Angela Stent, Putin's World. With all that's going on here, how would you judge how what I'm going to call the hard right of Russia, or the center of Russia, or what I'd call the liberal left of Russia, how do they adapt to the comments of the last 24 hours?
I mean, they get in line. What happens when you don't? Yes, Russia does have domestic politics. You see that whether it's the Communist Party in the Duma, which John and Lisa and I spoke about yesterday. They're the ones that came up in February and said we should recognize as separate entities Luhansk and Donetsk. And then Putin went in and announced his special military operation. It was also the head of the Communist Party that said we should now be calling this a war after that counteroffensive that may have led Putin to want to actually make these moves, because now he could put reservists on the ground in these territories if he sells to the Russian people that these are legal Russian territories.
Who are the reservists? I mean, maybe it's an unfair question to you, but in your reporting,
well, they also have
contractors. I know what a reservist is in Tulsa, Oklahoma. What's a reservist in the Ural Mountains?
It's individuals that join the Russian military that are not being used right now. You have to remember that Russia is also using a lot of contractors in this war. They're not going for full-fledged conscription, but they are calling up 300,000 reservists.
You count them as reservists?
This is putting the backs up of everyday Russian individuals. Domestically, this is going to be a bit more challenging for Putin.
Anne-Marie, is there any coincidence or any overlap with the fact that Xi Jinping just met with Vladimir Putin and now this move of possibly calling up some reservists?
It's the first email I woke up to this morning from a viewer who said Putin making this move after he just met with Xi Jinping. And remember, it was earlier this year that these two leaders said that their friendship has, quote unquote, no limits. What do we have also this morning? You have a seminar, a military seminar. Xi Jinping is telling that seminar to focus on preparing for war. You also have Kyoto newspaper saying that at the party congress next month, this is incredibly critical for Xi Jinping, that he's going to talk about his plan for reunification with Taiwan. Now, potentially, these two items were discussed amongst each other because Putin doesn't have a lot of friends right now. He has Beijing, he's getting some ammunition from North Korea, and the Iranians. That's really it when it comes to pure potential friends at this moment.
What's the U.S. doing in response to Xi Jinping? I mean, this is coming at a pretty fraught moment on multiple levels.
Well, Jake Sullivan, the president's national security advisor, yesterday said that the U.S.'s one China policy has not changed, but we heard for the fourth time from the president yet again to go a little bit more off script when it comes to Taiwan. In that 60 Minutes interview, really astonishing what he said. Not so much that they would just send warplanes and military. He was asked, unlike Ukraine, would you send U.S. personnel, military, men and women? And he answered yes. It couldn't have been more direct.
Anne-Marie, thank you. AMH here in New York City for the UN General Assembly. Tom Reuters reporting early this morning. I heard you squeezing Unger. Reuters reporting early this morning. You thought that was going to slide? Come on, AMH. Tom,
how'd it go there?
I've got to squeeze this in before we get completely derailed. Just a report from Reuters this morning that one-way flights, Tom, are standing out after this announcement. One-way flights from Russia. So direct flights from Moscow to Istanbul in Turkey, to Armenia as well. Destinations where Russians can enter without a visa.
Well,
they're standing out, Tom, off the back of this.
It's very fluid in our news flow, and that's why I'm looking at more and more of the European journalist coverage that we're seeing from Bloomberg and from other sources as well, John. I'll be honest, John, I just think it's simply off the American radar, slammed in this morning, obviously, but it bears the most careful scrutiny.
Absolutely. Is that an escalation? Lisa, I think parts of the market treating it as such an escalation. The euro weaker off the back of some of this. We saw the haven flow in the early part of the European session.
Is Vladimir Putin doubling down, right? It's raising questions about what else he could do. It does also, though, raise this issue, and Anne-Marie has touched on this very well, which is popular support of this, right? It's different when you have to actually go to war versus sit there and sort of hear the propaganda in terms of what the war is accomplishing. I wonder how much the popularity or some of the issues therein are affecting some of the jawboning, both when it comes to Russia as well as China, just based on the fact that they're heading into a People's Congress meeting that is coming at a pretty fraught time also politically and from a social perspective due to the lockdowns.
Readjusting our growth expectations lower. I saw your note from Deutsche Bank early this morning. Now we're getting real about what a recession in the Eurozone, Lisa, is going to look like.
Yeah, it was pretty depressing. I got to be honest, and the bar is pretty high for me to get depressed, but it really was depressing to see them downgrade their forecast for growth from negative 0.3% to negative 2.2%, and saying that there is potential for further downside because of the potential for a really cold winter. How much does this really get affected one way or another if there's an escalation? Does that really affect the gas supplies because a lot of people are just discounting them altogether at this point.
Can we just compare and contrast that with the ECB's own forecasts for 2023?
What's the growth?
They're at positive 0.9% for 2023. And Tom, you've got Deutsche Bank saying it's going to be negative 2.2.
Well, yeah.
And President Lagarde was asked a lot about this in the news conference. Where's the recession in the forecast? She said it wasn't in the base case. Should it be in the base case? Because I tell you, on most people, for most people right now, it is the base case for Europe.
We're moving in real time, and as we talk about these strange things like neutrality and that, John, the lift up in German yields is a different quality of lift up than America because of their more tepid nominal GDP and their lack of technology as an economy base.
Leaving behind the negative interest rate era and moving on, Tom, with much, much higher yields in Europe and beyond. Futures positive 2/10 on the S&P, on the Nasdaq 100, basically unchanged on this Fed decision day. Yields lower by 2 basis points. Your 10-year, 353.97. Is this a buy for Mike Collins and a team at PGIM? We'll ask him next.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Live from New York City this morning. Good morning. On this Fed decision day, here is your equity market, just about positive by a little more than 0.1% on the S&P. On the Nasdaq, negative 0.03%. You know the numbers. I'll talk about them again. Of the last 10 Fed decisions, on 8 of them, this market has rallied. Can this market rally if Chairman Powell brings out the Jackson Hole speech once more and just reads it verbatim? Once again, we've got work to do. This bond market's done a ton of work already. 12 months ago, we were at 21 basis points on a 2-year. Right now, 3.96%. Yields come in by about a half a basis point. On a 10-year, down 2 basis points to 354.36. A big change, though, over the last 2 months. Yields higher, yields so much higher in the US and elsewhere. Let's pick out a place where yields are not so much higher this year. Let's look at Japan. Look at what's happened with the bond market and look at what's happened with the currency, or rather I should rephrase that. Look at what hasn't happened with the bond market and look at what has happened with the currency. Yields have barely climbed this year relative to what we've seen elsewhere. They've kept them pinned lower, capped, trying to sit on them. A 10-year in Japan at about 25, 26 basis points. And look at what's happened with the currency because of that, Tom. We've had a 25% move on dollar yen. That is a monster move.
Yeah, stay on that for Bloomberg Radio, folks. 144.17 is a huge deal on yen. It's finally giving way to weaker yen just in the last 10 minutes or so, John. And, you know, you look where the level is, 145, 146, a dialogue changes.
Tom, even the central banks that have moved, they're still struggling. Look at sterling at 113. Yeah. Look at the Swedish currency, even with the Riksbank delivering a 100 basis point hike. Against the dollar right now, Tom, it's a tough go to get some kind of traction in the FX market, even if you are hiking, even if you're doing what the Bank of Japan is not doing.
Sterling intraday low, John, 113.05. A 112 is essentially unimaginable, except we're there right now. John, can I mention in our travels of the last 3 days for all of us, we have finally broken through on the index that matters, the Bloomberg Total Return United States Aggregate Index, summing in all the bonds. Lisa knows this better than me. Guess what? New low price on the index through the June low.
A difficult moment. I think Lisa and I are both looking forward to the conversation with Mike Collins and PGIM to see if this difficult moment is a big buying opportunity. That's the cross-asset price action. Want to get to a single name with you? We can do that now with Lisa. Hey, Lisa.
Hey, John. So, you know, Tom's been talking a lot about companies adapting and adjusting and how they really deal with the situation that they're dealt with. And there are 3 stories today that really highlight to me how they are doing this, and that is cutting jobs and cutting jobs on a corporate level. Take a look at Gap. Their shares dramatically underperforming the broader market, down 48% so far year to date. Just announced that it's cutting 500 corporate jobs in San Francisco, New York, in Asia. This comes after their partnership with the former Kanye West fell apart. It comes as they downgraded some of their forecasts in August. How much does this really tell a story for retail? How much is this idiosyncratic? Then take a look at Boeing. This is the manufacturer of big planes. They just said that they're going to outsource some of their finance and accounting jobs to India. Their shares are lower by almost by more than 27% so far year to date. It shows how people are trying to reduce costs in different creative ways, perhaps cutting jobs, perhaps outsourcing, not exactly the jobs that they used to outsource. They still are hiring some engineers locally. It just sort of shows the shifting winds. And then Compass, the housing market company that really depends on online sales, has been absolutely decimated this year. Those shares down more than 70% so far year to date. The CEO coming out and saying that it was going to be cutting more jobs, particularly in the technology sphere, and that there's more to come. There's some losses associated with this. Again, Tom, you've been talking about adapting and adjusting. That's going to lead to the pain that we're hearing from Fed Chair Jay Powell.
Well, where's the 30-year mortgage here in like a week or two if 6.2% goes out? Lisa, to the Gap, and I think this is really important, is one of the ideas here that's new with a risk-free rate is we finally de-zombify zombie companies. Do they finally go out of existence after a 12, 13-year gift?
Which it's full circle back to your point about corporate credit. Have we fully accounted for some of that pain in that market, considering the fact that there has been the repricing that you pointed to, but potentially there could be more to come?
Very good. We will continue right now on this on corporate credit with Michael Collins, Senior Portfolio Manager at PGIM Fixed Income. Michael, what I notice here, and I understand the mathiness of it, let's forget that. Yield up, we all know that. Chairman Powell will deal with it today. but in many cases, price very, very, very down. And we're seeing it in the Bloomberg Total Return Aggregate Index, the old Lehman Barclays indices as well. What is the significance of new low price on those aggregate indices?
Yeah, Tom, as you point out, has really been nowhere to hide this year in fixed income. I mean, in our shop, we've gotten three big things right. We've kind of stepped aside on duration, meaning taking our long positions down to neutral. We've taken credit risk way down. We've generally been a little long the dollar, but that has not been enough to protect investors from that big trend down in prices. The good news is, as you know, when bond prices are down below par, which they all are, really for the first time I can think of in my career, Tom, we're seeing the bonds across the board, across all of our portfolios, trading at big discounts to par. And as you know, as long as they don't default, as Lisa pointed out, they end up back at par, right? So you actually have this really a positive long-term opportunity in fixed income, which we haven't had for well over a decade.
Michael, I look at the mantra of the real yield, the whole professional study of the inflation-adjusted yield. Explain to mere mortals why the real yield matters.
Yeah, I mean, that is the world's discount rate, right? I mean, I'm always surprised when people say, wow, I can't believe stocks and bonds are both selling off at the same time this year. And what I tell them is, well, you just wait until you see real estate and private debt and other assets that haven't sold off because they're not actively traded, they're not marked to market every day. Wait for those shoes to drop, because when the discount rate, the world's discount rate, which is really real treasury yields by and large, goes up as much as it has, as much as, a couple hundred basis points, all asset prices have to come down. And the question really is, have they come down enough at this point?
Well, let's get into that right now. Mike, we caught up with our good friend Bob Michael of JP Morgan Asset Management yesterday. I asked him about high yield. He said, not yet. Patience. Spreads need to get somewhere close to 750 basis points. The treasuries need to get somewhere close to 4.5. The Fed funds could push 5%. Any of that resonating with you right now, Mike, or would you take the other side of that trade?
Yeah, I'll take a little bit of the other side on the rate thing. I think we're much closer on the rate side, right? Our view is that the rates are going to crest and come down first, and then credit spreads and equities will continue to widen and sell off before they settle down. But I think we're really getting close to a point, Jonathan, where the likelihood of the Fed and most other central banks overshooting significantly on the upside and having to reverse course. I know the whole concept of the pivot, was in vogue a couple of months ago, and now people are pushing that aside. And wow, as they keep pushing these rates up, at the same time that global growth, risk is coming down, earnings are coming down. As Lisa points out, defaults are probably going to go up. Geopolitical risk continues to elevate. Wow, and inflation globally is really kind of rolling over, and I think it's going to be probably a lot lower in a year from now. Just as all of those things are happening, these central banks are jacking up rates ad nauseum, and I think that's a real recipe for a big reverse course on the rate side. On the credit side, I think you're right. I mean, earnings, we've done a lot of work on earnings expectations going forward, and I think they're going to keep coming down, right? And people don't talk enough about the dollar and the impact on that for U.S. companies, for their competitiveness, for their repatriated earnings. The labor costs continue to put pressure on margins, and as Lisa pointed out, you're starting to see layoffs finally happen. So I think there's a little more downside in credit before you jump in with both feet.
This is all really messy, Michael. I wonder, just to put it all together quickly, if you could give us a sense of how you play this, the conviction behind buying certain discounted bonds, taking the other side of Bob Michael, but also acknowledging what you see coming.
Yeah, I mean, you stick with higher quality credit, right? And presumably that's what a big active shop. We have 140 analysts, Lisa, right? And that's really our bread and butter. And this is an opportunity in the market where everything is kind of sold off, right? In unison to some extent. And there are a lot of relative value opportunities. You can buy really high quality credits at really big yields, really big spreads, low dollar prices. So there is a lot of opportunity there without taking a lot of credit risk. And we've taken our credit risk down, but the yields that we're seeing across the board in the bonds we own, the high quality bonds we own, the portfolios we manage are really big, right? So, I mean, you don't have to take a lot of credit risk. Ultimately, you'll want to do that, dip down in credit, but it's definitely too early.
Just so I can quote you for the rest of the day and get it right, have you been buying this 10-year at 350, Mike?
Yeah, we haven't yet. We're dead neutral here, Jonathan. But again, that is going to be the big first trade really out of the gates here, and maybe you have to wait for today. The Fed is going to probably sound pretty hawkish today, even though they've done a good job on Fed days. I know we've talked about this on the program before. Typically, the days the Fed meets and the days Jerome Powell speaks, the equity markets tend to go up. So they do a good job of getting investors off the ledge a little bit. But you know, that dot plot is going to be ugly. I think a lot of it's probably priced in and the markets are braced for it. But there will be an opportunity, I would bet, in the next couple of quarters to really start getting long duration.
We'll catch up and talk about it. Mike Collins there of PGIM. Thank you, Mike. Now's not the time, Tom, but he did give you a sequence of events, a sequence of what he would buy and when and why he'd buy them before others.
I have trouble with the sequence. I thought it was really intelligent from Mike Collins, but, you know, what was the sequence events 12 months ago? And
Things
look where
change.
We are.
Buy treasuries first because growth's going to get hammered. This Fed will have to back away, but the pain and credit
portfolio.
will
Doug
continue.
Cass out with a note today.
What, 60-40, Tom, this year? Oof.
Oof.
Not nice.
You know,
Futures.
I mean, it's a triple leverage cash.
Up 1/4%. In fact, TK, you've outperformed everyone this year. Congrats.
The Chancellor called me while I was...
I bet. Can you run a portfolio at the Treasury?
Yeah,
Is that what he
triple
said?
leveraged all cash.
Sterling or US?
No, well, that's a
Yeah,
really
I
important
know.
point. You'd hedge it out.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third policy meeting in a row, policymakers are expected to raise interest rates by 75 basis points. That would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde has said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. China says it has the patience to someday bring Taiwan under its control. Now, a government official said that what he calls Taiwan compatriots realize the future is in unification. That contrasts with polling in Taiwan showing skeptical views for Beijing. Beyond Meat has suspended Chief Operating Officer Doug Ramsey. He was arrested on charges that he bit a man's nose during a fight after a college football game in Arkansas. It's another blow for the plant-based protein company, which cut its revenue forecast last month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
From New York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I thought that the Fed would never get to 4%, but I've changed that view. They certainly will, and probably by the end of this year. I think they're going to have to go higher at the beginning of next year, but then I think they'll pause. I also think they'll slow down their rate hikes the further they get away from the neutral rate.
That was Megan Green, the global chief economist of the Kroll Institute, and many people share that view. That's the change for the consensus view in the last 3 months or so. Most people now looking for that 4 handle and this market price for something close to 4.5. The Fed decides in several hours' time. Live from New York, this is Bloomberg Surveillance. Equities up by 1/3% on the S&P. On the Nasdaq 100, up by a little more than 1/10%. Yields lower by 3 basis points on a 10-year, 350, 358. We've got a Fed decision, a statement, of course, a news conference with Chairman Powell. And Tom, the forecast and a dot plot in the mix as well.
We do. It's going to be absolutely fascinating. Of course, we're thrilled that the former Vice Chairman Richard Clarida will join us here in a number of hours. As well, Vincent Reinhart. He's chief economist at Dreyfus and Mellon. But on this historic day for our central bank, Mr. Clarida, Dr. Clarida would suggest that Mr. Reinhart is a must listen. Vincent Reinhart invented modern research in Washington at the Fed for Alan Greenspan and has a terrific perspective on forecasts. Maybe not dot plots. We won't blame him for that. Vince, thank you so much for joining today. I went back and I did a Google search of the Fed blinks, and there's any number of dates where this is part of the zeitgeist. When does a central bank blink? When do they stop a theory to go the other way?
When the policy choice gets harder. Right now, here's the bad news. This is the easy part of central banking because they are so far away from their inflation goal. Jay Powell wakes up in the morning and says inflation is too high. He worries as he goes to bed at night, gee, inflation is still too high. Policy choices raise rates. It'll get harder when you have to top out where you raise rates And inflation is closer to goal and the unemployment rate is rising.
Vince,
Then the dual mandate matters.
I said of a certain vintage, Vince, that we're sort of used to higher interest rates, like an actual risk-free rate. We've all been there before. Does the media and the zeitgeist of Wall Street, do they overplay the world's coming to an end given a march to neutrality?
Just about every time, don't they? The fact is that there are long cycles in rates. We've been here before. The Fed goes through tightening spells and easing spells and pauses. And we're just in the tightening spell. It is going to have to last longer. That's a consequence of being slow out of the starting gate. It'll have to go higher. That's a consequence of being slow out of the starting gate. But this time next year, we'll be talking about how long will the Fed be pausing.
Vincent, we were just speaking with Peter Hooper of Deutsche Bank, who sees NAIRU, or the neutral, the end rate for Fed funds rates to be at near 5%, possibly exceeding that. We're hearing more people call for a greater likelihood of that kind of pain, that kind of rate backdrop for a prolonged period of time. Do you agree?
Yes, I think Jay Powell agrees with Peter as well. Remember at the last press conference, Chair Powell pointed to the estimates of the natural rate and said that's his committee's, his own view was higher. Well, generally when the chair is saying his own view is higher, it tells you the committee's going up. So I would expect in the summary of economic projections to see a higher natural rate. And importantly, they have to go above their natural rate in order to create some slack that slows inflation. So the base is rising and the overage relative to that base is probably higher given they started late.
Vincent, what do you expect the unemployment rate to be in those projections? How much of a downside, how much more of a potential recession case do you see starting to leak out in some of this forward look from the Fed today?
Well, the part to worry about is central banks are always incremental. They always don't lay out all the bad news. So I would expect the unemployment rate to go up. I would expect less of an immaculate decline in inflation, as has been the case in the last summary of economic projections. But I still don't think they'll be marking the reality. It'll be worse than what they say. So rather than an unemployment rate at or around the natural rate, as was in the last couple rounds, I would expect to see an unemployment rate around 4.5. In their forecast, I would expect the unemployment rate to be in the 5s next year.
Wow. Vince, you're on the same side as Deutsche Bank then. Vincent Reinhardt there of Dreyfus and Mellon, looking potentially for 5% unemployment. Too early to see that today, do you think, Lisa, in the projections? Because right now there's something close to 4 on unemployment.
Does it really matter? I mean, I think from a strategic point of view, people are going to be looking to see whether they pull a Bank of England and they give a dose of honesty. But does it really matter if they reflect that in their forward projections, if there is a general sense that they bring growth lower and they bring the inflation rate higher, they bring their rates higher, then you're basically going to extrapolate what you want to from that.
We'll catch up with Diane Swank a little bit later from KPMG, and I think Diane said the last few summary of economic projections we've had, the last few set of forecasts we've had, Tom, from this Federal Reserve, she's called them aspirational. Fanciful, I think, was the phrase Scott Minerd used as well.
Maybe we've migrated from fanciful here in the last X number of weeks. John, 4-week moving average on jobless claims. They come out weekly. You take a 4-week moving average. You know the math. 224,000. That is so far from a 5% unemployment rate. I just find the whole conversation.
But Tom, that's the point Deutsche Bank is making. This is what Matt Lazzetti, Peter Hooper are trying to say, that to get inflation lower, to bite into this economy, you need rates much higher. That's their view. That's their position.
Okay, well, we witnessed it. I mean, every airline's packed. I don't know if the airlines are going to make money. We've got certain Uber bulls like Jim Glassman at JP Morgan saying, look, here's where the consumer is right now. They've got a tough task if the theories we're hearing on the show are to play out.
And then we've got Mike Wilson of Morgan Stanley, Tom, who's just been right through the whole of 2022. Right to be bearish on this equity market.
But the equity market is where it is with the VIX at 26.97, John. And, you know, the classic rule is there's no angst till 30, and you may get a Mike Wilson 30 on VIX. The damage is in the bond market, John. The institutional mass, Lisa knows this better than me, the institutional mass that is losing money daily in the bond market is unmeasurable. I've never seen it in my lifetime.
It's piling up in a big way. Lisa, when FedEx came out last week, I think we both thought the same thing. We both thought of Mike and the call he's making on earnings, that we've had the rate shock and now we're going to see the consequences of it.
And what is the read-through to job cuts? And I say that as we look for a path to get to that greater or a few less slack in the labor market when we talk about a 4.5% to 5% unemployment rate. And you start to wonder, how quickly are these forecasts getting downgrades? And our gap is Boeing, is some of these companies that are coming out, Compass, are those outliers, or is that going to be much more common?
What would make Mike Wilson constructive on this equity market again?
You can ask him.
The man from Morgan Stanley joins us next. Looking forward to it. Futures up 0.4% on the S&P on this Fed decision day with Tom Keene, Lisa Abramowitz, and Jonathan Ferro. Futures are positive from New York. Heard on radio, seen on TV. This is Bloomberg Surveillance.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Power policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What's been really the engine here has been the strength of the labor market, the strength of the consumer.
The June 17th low is not that far away from here. It's not a heroic call to say that anymore.
We're also not convinced that the data is going to be bad enough that it's going to take us down through new lows for the back end of the year.
The Fed will have to shift or we're just going to go into a deeper recession than we may already be in.
The Fed funds rate will overcome the rate of inflation. That's when the Fed has done enough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on Fed Day. So much to talk about. Richard Clarida will join us, the former vice chairman of the Fed, to lead our Fed coverage today. John, I want to switch from the Fed to the stock market with Mike Wilson coming up. It's a toxic brew out there. There's blood on the streets.
And Mike's got it right all year, Tom. Dead right, dead on. Basically, look for the rate shock and now look for the earnings concern. And are we starting to see that with companies like FedEx, like Ford, in the last week?
Off the Gulfstream, what I notice is the Bloomberg Total Return Bond Index, John. It is through to new lows, breaching the June lows that we've seen. The 60-40 Bloomberg Index down 17% from the peak. There's nowhere to hide.
Bob Michael at JP Morgan, Tom, says it's going to get worse. He's looking for Fed funds maybe to get close to 5%, for treasuries at 4.5%, and for high-yield spreads to go somewhere close to 750. His message is not to buy yet, to wait, to be patient, to wait for a recession that he thinks is coming soon.
She was expert at unknown. I said, who is that woman in print? Lisa Abramowitz, expert on the spread market. Lisa, the spread market always says so much. What's it say this morning as we go to Mike Wilson?
It's saying there's a little more fear. It's just beginning around the edges, but not getting carried away. And there's a question of what exactly it's pricing in, because it's still far below some of the heights at the other times when we've seen not only rate hiking, but also credit fears. When does this problem, this goes directly to Mike Wilson, when does the issue with rates bleed over to an economic pain story? We've seen that play out in certain equities. Have we seen it fully play out in credit? You know, JP Morgan, at least JP Morgan Asset Management, Bob Michael, that side of JP Morgan.
I like how you clarify
doesn't think that we've seen enough
not
of
the
it.
equity research in the investment bank. Is that what you're implying?
I mean, I don't know that.
Zero Hedge messaged me a moment ago and asked if Bob Michael had spoken to Marco recently. That was the message I received. Read between the lines. I'm not here to cause trouble, okay?
Keeping the gossip running here. I'm going to get the data check going because we need to get to Mike Wilson for Global Wall Street on radio, on television. And John, FX speaks volumes. It is a litmus paper of the system. Yen up through a 144 fractionally. Euro visited new weakness. And sterling, we couldn't support it, John, on our trip there. I tried.
Oh, you tried. I know you did.
113.45.
I'll give you a snapshot of foreign exchange right now. Dollar stronger against everything with the exception of the Swiss franc. That's how defensive things are. Euro dollar negative 0.6% and just about holding on to 99 on euro dollar, 99.08. Yields down 3 basis points. They've been so much higher recently over the last few weeks. In fact, for the 10-year, the last 2 months, 352.79 on a 10-year. Tom futures just a bit firmer, up 1/3% on the S&P.
It is so true that the media, the financial media, loves to look at strategists and say, are you right or wrong? You failed, you're done. The reality is the way strategists are used on Wall Street, and no one has given more guidance this year in the last 12 months than Michael Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley, because it's been a consistent and cogent message of beware the future. Mike, we are now where we have a Mike Wilson stock market, and what I note is you mentioned it is picked over. I can't find scale. There's not enough to choose from. Where do I hide?
Yeah, well, thanks, Tom. I appreciate your kind words. I mean, look, I think the market is picked over because this is where we are in the evolution of this bear market. Essentially, when bear markets begin, they always go after the high flyers, things that are kind of ridiculously priced or where the earnings risk is more evident. And that's what happened really, kind of earlier this year, late last year, quite frankly, really began almost a year ago. And but as you kind of go through, people are getting high. It's like, when the water rises, you go to the higher part of the mountain. And so everybody's kind of crammed into the same stuff, just kind of waiting for, some conclusion to this story. Either we avoid a recession and move forward, have a soft landing, or we don't, and we clear the decks, and then we can move forward from there. We're kind of more in that second camp because our view on earnings is just so negative. Whether we have a recession or not, all of our top-down models, which are, pretty good, are telling us that, the spread between our forecast and the actual forecast by the street, bottoms up, has never been wider. It's the only time it's been this wide is, in 08 and then back in 01, and we know what happened there. So the earnings story is what we're focused on. The Fed is important still. Obviously, they're not getting off the gas here on their hawkishness, and nor should they. But that's pretty priced. I wouldn't be surprised if today we get some relief, quite frankly, led by the bond market after the Fed does their thing. Maybe stocks can rally one more time. But the end game for us is all about the earnings and the growth now. And we're just not optimistic there for the next 6 or 12 months, and that'll get priced pretty quickly.
So you've got 3,400 as the base case, 50% probability. Mike, 3,000 the bear case recession scenario, 40% probability. I put out this research, that quote, on Twitter in the last week, and a lot of people wanted to know, where's the other 10%, Mike? What's the 10%?
Yeah, that's the mystery. Now, it's pretty straightforward. The bull case is just not that probable. I think, November, and we talked about this, as you recall, John, right? The bull case was Goldilocks. And we said, well, the probability of Goldilocks looks pretty unlikely. So our bull case, we can flex that from, 0, or not really 0, but 5 to 20%. We're, sort of 5 to 10% now. But the bull case is no longer Goldilocks. It's kind of this soft landing for the economy. However, that's not a soft landing for earnings. So, our bull case is not much different from our base case. We think maybe you don't make new lows in the bull case, but there's not a lot of upside, over the next 6 months. And that's really how we manage money. We look at risk reward, and at 3,900, the risk reward is probably 5 to 1, on the downside. As sort of the middle of our viewpoint, and that's at the S&P level. I want to make this clear because Tom asked the right question, which is this is the part of the bear market where you should be looking for individual stocks that you want to own coming out of this. Some are priced appropriately where you want to take that risk, but look what happened this week with FedEx. Clearly that wasn't priced. So you got to be really careful, thinking, oh well, everybody knows this, it's already priced, and you get hit over the head and the stock's down 20%. So that's, everybody has their own risk tolerance. They have their own work. And, we have our own focus list as well. We're staying defensively oriented. We're not reaching for cyclicality or, kind of crazy growth stocks yet. We think it's premature for that, but we're getting closer. We think we're within a couple of months probably.
So there's an issue with how long this is going to last. And we were speaking yesterday with Chris Verone, who talked of a lost decade of profits on the headline level for the S&P, just based on the fact that yields are going to remain higher, inflation is going to be greater. Do you agree, or do you think that we're going to get a rebound on the other side of this 6 months, 12 months down the line?
Yeah, I think we will get a rebound, but our view for a while now has been we've moved out of the monetary policy dominant world to a fiscal dominant policy world. And what that means is that the Fed is no longer, and other central banks, quite frankly, can no longer smooth over the edges the way they have historically, because inflation, while maybe it's going to come down over the next 6 months, which is our core view, it's not going away. It's going to be dormant, and then we'll reaccelerate again in the next upturn. What's going to happen, Lisa, I think, is that you're going to clear the decks enough on expectations on growth that you can then have a reacceleration. And that will be driven by the natural ebbing and flowing of supply and demand, but also more aggressive fiscal policy. I think it's interesting to note in the last month, fiscal policy has been turned down like a spigot again, right? We have this debt forgiveness program here. We have this 200 billion pound stimulus for energy subsidies in the UK, which is equivalent to $1 trillion in a U.S. economic standpoint. So it's kind of interesting. You have kind of, everybody's worried about inflation, but the fiscal policy is working counterproductively to the monetary tightening. But that's the world I think we're living in now. And you have to understand that because it's not all bearish, right? There will be a time when fiscal picks it up again next year, even though monetary can't do its job it has been doing in the past. And the Fed's job, in my view, and the ECB's view, and ECB's job, in my view, their main job going forward is to be funding the government. Whatever the government decides to spend, they will have to fund implicitly, very similar to the 40s analog that we've been using.
Mike, just one further question, and I think it's lost in the conversations I often see with you, that it's not just about an index level call with you and the team. There is some single name stuff in the mix too. Could you help us with just a call right now, something you do like in this equity market, something that has worked that you're sticking with?
Yeah, I mean, I think like the managed care stocks have been terrific, and that's an area that these are growth stocks, and they're not priced as growth stocks. They never have been because of concerns about perhaps regulatory oversight and things like that. But healthcare in general, I would argue, is an area of the market where you have pent up demand from the pandemic, as opposed to payback in demand, like for technology spending or consumer goods. And for whatever reason, it still trades really cheaply. And that, once again, it goes back to this idea that there may be fear about pricing controls and things like that. But to me, that's a fat pitch, and that's an area we've had a lot of exposure, be it in pharma, managed care, some of the cheaper areas of healthcare, and I think that continues to work. The other area would be, say, integrated energy companies, where they're more defensively oriented, not so dependent on the price deck. They pay a great dividend, and you get some commodity exposure, as a hedge against inflation staying sticky or hot. But the overriding message, John, as you know, this year from us has been defensive, earnings stability, operational efficiency, boring type metrics. But it's been working nicely, and I think it will continue until we get the trough in this bear market.
It's been working in a tough year. Congrats to you and the team, Mike Wilson, so far for 2022. Just absolutely brilliant. Mike Wilson there of Morgan Stanley. TK, a man who's called it along with his team really well through the year so far.
Yeah, what's important here is how they dovetail in. I really can't say enough about the fractious nature of Morgan Stanley research. I love, John, how they're argumentative and visibly argumentative. You saw that with Zentner moving from transitory to a more difficult inflation.
Along with pretty much everyone else, Tom, who had to move from that. Futures up 0.4% on the S&P. It is Fed decision day for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin declares it a fight to the death with the U.S. and its allies. He is calling up 300,000 reserve troops in a major escalation of the war in Ukraine. Putin also hinted at the use of nuclear weapons. He said that the U.S. and its allies want to destroy Russia. A Ukrainian counteroffensive in the last few weeks has dealt Russian troops their worst defeats since the early months of the conflict. The Federal Reserve is poised to raise interest rates today to the highest level since 2008, and it's likely to forecast that there will be further increases. For the third straight meeting, policymakers are expected to raise rates by 75 basis points. Fed Chair Jerome Powell is expected to stress the Fed's resolve to curb inflation that's near a 40-year high. The Bank of Japan is trying to cap upward pressure on yields before a policy decision later this week. The central bank announced an unscheduled bond buying operation. BOJ Governor Haruhiko Kuroda has emphasized his determination to maintain rock-bottom interest rates, even though many other developed nations are increasing them. And Amazon's cargo airline is growing at the slowest pace since the start of the pandemic. Researchers with the DePaul University's Chaddock Institute of Metropolitan Development say the number of flights on the company's air freighters rose just 3.8% between March and September. The e-commerce giant has already closed or delays plans for dozens of warehouses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
I think it's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with, the economy slowing. At some stage of the game, the Fed will have to shift or we're just going to go into a deeper recession than we may already be in.
Kathy Jones there of Charles Schwab going into that Fed decision a little bit later this afternoon. Futures higher by 1/3 of 1% on the S&P, on the Nasdaq up 1/10 of 1%. Max Kettner of HSBC just publishing, hedge you win, tails I lose. We retain our maximum underweight in equities. If growth continues to hold up, central banks will have to do more to slam the brakes, putting pressure on valuations.
Yeah.
And he goes on to say, but if activity disappoints quickly, falling growth and earnings expectations will also be bad for risk assets. Tom, tails I lose, heads you win.
Can we state in London over that long duration, a wonderful stay there amid the sadness for England, that Max Kettner was our gloomiest guest? I think
he was also a bit of a highlight at the same time, Tom. It was great to catch up with him. Like Mike Wilson, gloomy but right through 2020.
Well, anyone else?
Tom.
No, Max brought the walk.
Ramo, gloomy but right.
Thanks, I appreciate
for the last
it.
12 months.
Thank you. Carry on.
We're doing your victory lap. That's it.
I could go around the room.
No,
maybe not.
It's true, and also her Grand Banks 42 is, that's what it says, John. Gloomy but right.
Is that what it says?
That's my bumper
sticker. That's the name of her boat.
Very
cool. Now, Michael McKee with us here as we dive forward into the Fed meeting, and again, Richard Clarida is scheduled to be with us, which is Wonderful. Mike, I have such a respect for your ability to drill down into this minutia. I just am unable to do it. Which of the forecast, which of the dots, what is the item you will look for first when they release that stuff this afternoon?
Well, I think we're going to be looking at the median dot, which does come out in the SEP as well as on the dot plot, because what people want to know on Wall Street is how fast are they going to get to terminal and what do they think terminal is? And then the third question is how long is it going to stay there? So all three questions will be sort of answered in one line on the economic projections. Then we'll also look at unemployment because the Fed is going to forecast under its dot plot what it thinks unemployment will be. And that sort of tells you what they think is acceptable in terms of unemployment if it follows the book and unemployment goes up. So far, they haven't had a whole lot of luck pushing that up.
Yeah, the dot, for those of you on radio, you're advantaged right now because we just showed the dot plot. It looks like the landing effort at JFK in a blizzard. Mike McKee, beyond that, there will be the questions today. It's unfair to say what is the question you will ask. What does he not want to say in the press conference today?
Oh, he doesn't want to say anything about a possible pivot one way or another, whether he uses that word or another. He doesn't want to suggest that the Fed is in any way going to back off. At least for a year, maybe longer. We'll see in the dot plot how long they keep rates up. You look at what Fed funds futures are pricing, and they see the Fed starting to cut rates in May of 2023. And that is exactly the feeling the Fed doesn't want to encourage. They want people to think the Fed's going to get rates up and keep them there until inflation goes down.
Mike, does the Fed have a serious credibility problem?
I don't think so. It's kind of funny. The comment you were leading in with about heads I lose, tails you win is kind of an admission that the Fed is going to do what it's going to do, and they're looking at how that's going to impact asset classes. I think they do need to follow through. If they were to back off at any sign of weakness in the economy, then they would have a credibility problem. But so far, when you look at the inflation expectations, they're relatively anchored. They're actually coming down a little bit. So I think people are have bought into the Fed's program at this point.
One of the biggest unknowns right now is how long it's going to take for this economy to truly feel higher rates. And the reason why this is important is because some people argue that the Fed won't know if they dramatically overshoot until it's too late. How much are people gaming out the length of time, the duration it takes before we start to see the ramifications of a 4% Fed funds rate?
Well, you've got sort of two camps out there. One that thinks the Fed can maybe bring us in for a soft landing, and if it doesn't, it'll be a mild recession, and it'll come probably later next year. And there are others who think they've already gone too far, and we're going to head into the teeth of recession fairly soon. And you see that reflected in those Fed funds futures. But the problem for the Fed is the data they watch to see where they are is backward-looking, and the effects of their policies is forward-looking with the lags. So they've got to try to extrapolate between the two, and it isn't easy. And that is a question on my list for Jay Powell. How are you going to know where you are and whether or not you've gone too far? And they have always said, well, we know how to deal with inflation, so if inflation went up too high, we would know what to do and we could pivot right away. But what if the opposite is true? The economy starts to really fall, and the Fed doesn't know that's happening yet.
Mike McKee, thank you. Mike, thank you very much. And looking forward to the news conference with Mike McKee and his coverage later on the Fed show. The Fed decides. Lisa, we talked about that, didn't we? Is the Fed being emboldened by a lagging indicator?
Well, I mean, and basically, that's the issue at a time when you're starting to see the FedExes of the world come out and say things are moving so quickly, they have to readjust their forecast. FedEx might be dealing with some specific issues that has to do with FedEx and FedEx alone, but we're also seeing it from other companies. At what point does that become relevant for the Fed? Is that data that they're going to track?
Andrew Hollenhorst, the City, just published. He said a hawkish surprise would be Powell suggesting upcoming hikes will remain larger in size, or that neutral policy rates have migrated higher. A less likely dovish outcome would be Powell emphasizing that policy rate increases will slow or pause at some point. Tom, once again, the news conference often about emphasis of the Fed chair.
Yeah, and also the market's going to be watching, and we're going to correlate all that in at 2 p.m. here on equities, bonds, currencies, commodities. John, moments ago, Euro Swissy made a dash to new Swiss strength. I would suggest off Russia fears, Putin fears, and that. But we're at a point where dollar's on the cusp of breaking out. We're not there yet, but can you imagine dollar strength into the press conference?
I can, because we're seeing it right now.
I was about to say.
Right now, 110.77, 111 potentially going into this
Look,
news
the Bloomberg
conference.
DXY, same thing.
Yeah, euro dollar just clinging on to 99. Sterling, Lisa, 113. Levels that if we'd mentioned at the start of the year, I would have laughed. And who pointed that out just yesterday in yesterday's conversation?
Yeah, that's right. I think that was Chris Ferrone.
It was Chris Ferrone.
He said,
he called me out of the commercial break. He said, John, I watched back one of our interviews earlier this year. I was like, oh no, here we go. I said 150 on dollar yen and you laughed at me.
And guess what?
We're not at 150.
That was exactly what John said. He said, you totally missed it. We're only at 144.
What a terrible call.
You're just going to keep hammering that. You're going to stick to it, huh?
I think it's a great call. Let's give it to Chris. 143.98 on dollar yen. Michael Pond's going to join us from Barclays in just a moment. Euro dollar just holding on to 99, negative 0.7%. This is Bloomberg.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
from New York City this morning. Good morning to you. Just about positive on the S&P by 0.5% on the S&P 500. Futures up on the Nasdaq by 1/3%. Also pushing higher, yields pushing lower by 4 basis points on a 10-year, 352.60. Euro dollar just about holding on to 99.06. That currency pair negative 0.6%. Some real dollar strength out there in the mix. Shout out to Paul C on Twitter. We've got to rename the program, Tom. Bloomberg, the Brit, the Bear, and the Bow Tie. Great way to start the day. Thank you. Thank you very much for that. I think that works. We should rename the podcast The Brit, the Bear, and the Bow Tie.
Yeah, we could do that. I think the podcast, that works as well. And that's
that works beautifully.
Digital product. And if you look over the years, the digital product's becoming more and more important, including podcasts. We're working on that every day with Scott Havens, and we'll move forward on that now that we have all returned. Right now, we return to what started the program years ago, which is speak to people that actually spend 24/7 on something narrow and excellent. David Rosenberg, Parsing Inflation, maybe Stephen Englander in his brilliant work on cross rates and FX. One of those some years ago was Michael Pond. His fancy title now is Head of Global Inflation-Linked Research at Barclays. Far more accurately, he is truly expert, with the exception maybe of Ian Lingen at BMO, on full faith and credit, and he joins us today. Michael Pond, if I look at the real yield, and I look at two partial differentials of the nominal yield and some measurement of inflation, which matters right now?
It's the real yield that matters, and it's moved up a lot over the summer. The market was not really buying into the Fed's resolve to hike rates enough to slow the economy and getting inflation down. Since Jackson Hole, though, real yields have soared, particularly at the front end, where they were almost at zero earlier this month. Now they're above 1% when we look at short end forward. So the market's moved a lot and really accepted the hawkish tone of the Fed.
So if I look not at the 10-year real yield, but Michael Pond, let's go shorter to maybe the 2-year, if you agree with me on that, from a negative 300 basis points inversion to a positive 164 basis points. That's a hugely linear jump condition. How do other asset classes react to the Michael Pond world?
Well, risk assets do not love higher yields that are not supported by strong growth. Really, where real yields are rising here is because the Fed has become much more hawkish, trying to slow the economy. And that's in part why risk assets have been on the back foot since Jackson Hole. So the Fed's trying to get the economy in a position where inflation comes down, and then it can take its foot off the brake a little bit and allow growth to go back up. But we think we're years from that. The Fed's resolve is strong here. That was clear at the Jackson Hole speech by Chair Powell, ripping up the script then and channeling his inner Volcker. Risk assets have responded, but now they're at the point where perhaps they've overreacted. Obviously we'll get a message from the Fed that's on the hawkish side, but markets are already prepared for a very hawkish Fed. So it's a delicate balance today.
Before we veer too far into that, they might be prepared for a hawkish Fed. There's a question of how quickly that leads to economic deterioration, and we can get there. But I want to sit on this idea right now of what it means to have a Volckerized Federal Reserve, particularly with real rates at the highest levels going back to 2011. Do you foresee ever again in the next few decades this Federal Reserve going back to zero interest rates?
It's very possible. We thought that the market was pricing in too high of a probability of strong Fed cuts in next year in late summer. Those have basically been taken out as appropriate. But we certainly could, if you look at the housing market and say the housing market becomes a sign of the broader economic outlook, then we could be in trouble here, and the Fed would have to respond, putting its dove hat back on. We think we're not likely to enter that regime, but it's certainly possible that we enter a recession. The Fed has to backtrack and send rates right back to zero.
Well, okay, so this is sort of the big tension right now in bond markets, particularly on the long end, with the 10-year yields at the highest levels that they've been going back years and years, and yet some people, including Michael Collins from PGIM Fixed Income earlier, saying it's unclear whether it's really time to pounce. because there could be more. Is this the last time that we'll see real yields of this level because this Fed is poised to make some sort of turn in the not-so-distant future?
I think it 100% depends on the path of core inflation readings and the labor market. That's why the Fed is reacting so hawkishly here. They've done quite a bit. Some parts of the economy has begun to slow, such as the housing market, but the latest print on core CPI was 0.6, and labor markets clearly remain quite tight, quite robust at a 3.7% unemployment rate. The Fed really needs to see a slowdown in the monthly pace of inflation readings, particularly on core, and a weakening of the labor market. Again, the chair talked about inducing pain in the economy. Again, channeling his inner Volcker in order to get inflation down. So the Fed has to do a lot more to get the economy where it wants to.
Michael, you embrace a dual mandate, and I get that. And we could talk all day about jobless claims, this, that, and the other thing, or trim mean Dallas. Maybe the chairman will bring that up today. He's got another mandate, which is the credibility of the Fed buttressed up against political realities. If we get a Barclays recession, if we get a Barclays sort of recession, does that become a third mandate for this chairman?
Well, the Fed is absolutely trying to make sure it retains credibility, particularly when it comes to inflation fighting. So one of the reasons why it's being so hawkish here is to make sure that inflation expectations don't get out of control, because that's when the Fed fears an inflationary spiral, where inflation is high, people expect it to be high, and it just feeds on itself. So one of the things the Fed is trying to do here is make sure that high inflation itself doesn't lead to higher inflation expectations. So it's trying to maintain its credibility. And if we look at break-evens, if we look at surveys such as that from the New York Fed or the University of Michigan, the Fed's doing a good job on that front, and it's able to ignore any political issues with a slowdown.
John, I'm sorry, politics matters here. It's going to matter tomorrow for Bank of England. It's going to matter today for Chairman Powell.
Oh, Tom, I don't disagree. And I think, Michael, this is going to be the difficult part. How do they convince people that higher unemployment is a price worth paying for lower inflation? Easy to say that now, but when people actually start to see materially higher unemployment, how difficult do you think this is going to get?
Well, that's why the SEP, the Survey of Economic Projections, or the DOTS, if you will be so important today when we get the statement. When we look at the statement, one of the things we'll be looking at is the unemployment rate path. So, the SEP is supposed to be the economic outlook under a path of perfect monetary policy. And if the unemployment rate remains elevated in their forecast, that's a signal to the market that they're willing to tolerate decently higher unemployment rates in order to get inflation down. That's a message that the Fed has been sending, but we'll really be looking at the SEP to confirm that.
Michael, just real quick here, I'm wondering what your projection is for how quickly inflation will come down, that headline CPI, at the end of this year, at the end of next.
We're fairly optimistic that it will start to slow, particularly with the October reading, in part because of technical reasons, at least in CPI. But even beyond that, again, we've seen signs in commodities and shipping rates, in ag-related futures, corn, wheat, et cetera, that many price pressures have peaked. Wages, though, are keeping inflation high, and that's the key to inflation really rolling over.
Michael, just quickly, what are you talking about in terms of levels? Are we going to end the year at 6%, at 4%? When do we get back?
We think we'll certainly come down from that when it comes to headline inflation, in part because of the strong decline in gasoline prices since March. But core can remain sticky. So we think we'll slow in inflation readings, but certainly well above where the Fed would like them.
Michael Pond of Barclays, thank you. Everyone at Barclays went very quiet when this interview started. I can tell you in the commercial break, there was this beautiful bus, this hum, coming off the trading floor over at Barclays. Tom, wasn't that fantastic?
Yeah, they put
thanks to Michael, too.
Senior management put a memo today. Pond is on with surveillance, so
I know, but they should just
pipe in some music.
Bus, TK, was just
great.
Beautiful.
Just like old times.
I've missed that.
Yeah, well, and frankly, for Q4 and into next year, that's a big debate. John, The Guardian in London, the acclaimed Ian Fraser, one of the great authors and thinkers of economics in your United Kingdom. I love what he resurrects from Ronald Reagan, trickle-down economics. John, is that what we're observing?
Yeah, you should probably have a look at the Martin Wolf piece in the Financial Times as well, because it was pretty scathing, TK, and what's about to come from this Conservative government.
Well, this is out there and in real time. And, frankly, for our American listeners and viewers, what goes on tomorrow has a profound effect on what goes on in America.
We get a Bank of England rate decision and a mini budget. I've got no idea if...
John, I meant the Sun start.
Oh, that's what you meant.
That's what I meant.
That's important too.
That's important.
I've got no idea if Martin wrote this headline in the FT, but Lisa, the economic consequences of Liz Truss was the headline of that piece in the FT yesterday.
Well, Danny Blanchflower over at Dartmouth, he put this out on Twitter.
Pretty predictable, isn't it, Danny?
Okay, yes, but he said, he's done many interviews. He's discussed these disastrous economic policies of Liz Truss, as he said, and he said that they're in total disarray, but it seems inadequate as pronouncements get worse daily. I have never in my 50 years of doing economics seen anything as bad as this.
I want to see what the complete package looks like. The two that we've heard of,
fair,
ending the cap on banker bonuses, that's going to get the wrong kind of headlines. Then the one that we heard of in the last 24 hours was on reducing stamp duty, which for anyone not familiar is just the transaction tax that you pay when you buy a purchase or a house in the UK, Tom. And that's at different levels relative to how much that property costs. Let's see what the complete package actually looks like.
Yeah, well, when I was looking at Knightsbridge yesterday, that's why I came back a day late. They said maybe the transaction tax would be gone.
You trying to buy TK?
Well, we're looking.
I'm not sure. You know that you can go on stamp duty. Just Google it and have a look at how much you'd have to pay on a big property in Knightsbridge.
You're kidding me.
Like real money.
Yeah.
I mean, you need the real money to begin with to buy the house.
But I mean, is real money at a 105 sterling or here at a very rich 113 sterling?
Are you waiting for it to decline a little bit more?
Yes, I am.
Okay. Euro dollar 99.12. Got a stronger dollar in the mix. Equity markets firmer. Yields are lower. All of this going into the Fed a little bit later. Looking forward to a Fed Decide surveillance special a little bit later. Do not miss this with the former Vice Chair, Richard Clarida, in the studio with the three of us, breaking down the decision and going over the news conference too. But do you want any more than that, Bramo? Isn't that just fantastic?
I'm so excited.
And Chairman Powell's going to... He's not calling it.
He's only...
Right.
Clarida's only here... Clarida, John, Clarida's only here to see Bramo. He doesn't care about us.
He doesn't care about us. He's here to see Lisa, of course. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third meeting in a row, policymakers are expected to raise interest rates by 75 basis points, and that would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at
big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
In London, in Sydney,
in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
how
story.
are you thinking about those dynamics?
There is some thought that we're getting to peak hawkishness, but that's not going to move the market now. It's the earnings that are going to move the market and a realistic reset of where we're going in this.
Alicia Levine there on the equity markets with BNY Mellon Wealth. She's just given us so much insight, particularly with her math foundations. Before we move to events with the United Nations General Assembly, Lisa, I think we've got to look at what's moving in the market. And just one idea off of what John was mentioning on the Bank of England tomorrow. If you take the sterling, Lisa, and you extrapolate it out, the weakening has been so rapid that we see a 1.1099 extrapolation in a cup of good British coffee, September 29th. I find that extraordinary, Lisa.
The fact that people are talking about the potential for parity at a time where there's a 1-2 whammy punch of an economic backdrop forcing the Bank of England to raise rates, and then a fiscal plan that has endless spending and tax cuts that's leaving a lot of people wondering where the foreign investment is going to come from.
We'll continue to monitor this, and of course we go to our Federal Reserve coverage this afternoon with Richard Clarida. We're just honored the Vice Chairman would choose to give us extended comments. I'm sure he'll be delicate there, and a delicate moment for Chairman Powell. Right now, it is a delicate moment for anyone efforting climate, and I will not mince words. Michael Bloomberg, who signs my paycheck, has been a world leader in saying, forget about the big picture and look at the smaller tactical realities. He provided leadership at Paris a number of years ago on this with the mayor of Paris, Ms. Hidalgo, and does again today with the Earthshot Prize. Francine Lacroix is covering this story and will be part of selected panels there. Francine, this is the effort of the Prince of Wales. He is distracted with the sadness of his family. What did Prince William bring to the Earthshot Prize Innovation Summit?
Well, Tom, this is about, I think, rallying the troops. This is about finding small innovations, as you say, that could actually make a real difference in real-world economies. So this is very much at a city level. This is incubators. This is about getting funding to the right place. But remember, we're here in New York, and the overarching idea is that, yes, we see more and more climate disasters. We see, of course, our woods burning. We see the forest burning. We see no water in the Rhine, which is a whole host of problems for the economy. But if you're a world leader and you focus, of course, on world poverty, inflation, the war in Ukraine, this may not be a priority anymore for you.
How has this prize and the work of Prince William changed because of the war, because of the surge in energy? Not the threat to ESG, but the idea of climate debate on a back foot due to the price of commodities and coal. How has it changed this summit?
Well, it's changed it enormously, and I think the biggest story to come out of the UN in general was President Biden today meaning to attend a meeting to actually really lay out some of the groundwork ahead of COP27 in Egypt, saying actually he had no longer time to go to that meeting. Now, of course, he sent envoys, but it's not exactly the same thing as having the top boss and saying this is still a priority. Again, if you look at energy concerns, if you look at the cost of living crisis, there is a real concern, which actually the United Nations Director General addressed right at the start of UNGA yesterday, was like climate still needs to be left front and center. The other question is that, of course, King Charles III, I know you were in London for 10 days covering, of course, the funeral of his dear mother, Queen Elizabeth, was a real spearhead in this. And if you look at the UK with all the concerns about, sustainability, they even have an energy minister who is not the biggest champion, let's put it that way, of climate change efforts. It's possible that the king has to step down for anything vocal and to really try and push this climate change agenda.
Francine, how has the shortage in commodities, or maybe not the shortage, but the higher terms of what commodities will be necessary for the innovations to cleaner energy?
So this is one of the conversations that I used to have, for example, with the Glencore chief executive. For the last 4 years, I mean, remember, they still have coal mines, but a lot of these big miners, and we saw some of the efforts, for example, from Fortescue, keep on saying, like, look, it's all well and good to transform some of these transition economies into something greener, but you need cobalt. You need some of the components that, of course, are needed not only in electrolysis, but some of the technology needed. And he used to say, the fact of the matter is that the government has not prepared for this. He wasn't talking about one specific government. He said the US is not prepared for this, the UK one, even the Eurozone is not prepared. With time, and if there is still commitment from not only countries but private and public partnerships, then you could see a lot of the mining companies, again, really ramping up some of the cobalt and some of the minerals really needed to use in these components. But, again, it's about commitment, and it's about the money to be able to make sure that these places are secure.
Francine, thank you so much. Greatly appreciated, from the Plaza Hotel and the Earthshot Prize Innovation Summit as well. In the time that we've got left, dear Lisa, I think we have to frame back to just an absolutely tumultuous 2022. It seems like we've lived 2 or 3 years just going through the years today. And my great observation, Lisa, is we're at a point where we're not even to neutral yet, based on all the experts we talked to.
It's shocking. And just to give you a sense of that, more than a dozen central bank meetings and rate decisions will be had in the next 24 hours as we look out at all of these nations dealing with something very new relative to the past decade or two, which is inflation. And one way to kind of look at this reset, this regime change that we've been talking about, Tom, is to take a look at the total amount of negative yielding debt outstanding. This is now becoming obsolete, save for Japan. We now have $1.9 trillion of negative yielding debt outstanding, according to Bloomberg indexes. Just to give you some perspective, that was $18.4 trillion of negative yielding debt in December of 2020.
These are flows of money, and the flows destabilize. We had this. Let's try to get this up right now. Just from the beginning of the year, it's not year to date, but it's close enough to the peaks that we've had, Lisa. The Pacific Rim ex-Japan, which is a fiction, we all understand that, a 9% depreciation. The JP Morgan emerging FX indices, which is more complex, an 8% depreciation. Those are big figure numbers in foreign exchange and for the United Nations and frankly for Chairman Powell.
Yeah, and the extreme version that John was showing earlier of 25% depreciation of the Japanese yen in the more violent example here.
Right.
But yeah, especially the emerging nations. How do you deal with also a double whammy of both higher commodity prices and importing inflation? The fact that those commodities are paid for in dollars that are getting stronger becomes a very difficult equation, especially as we head into winter.
2-year yield, 3.95%. That's what I'll watch here at 2 p.m. and on to 2:30 in the press conference. Lisa, in fixed income, what will you watch?
I mean, I'll watch the real yield. I'll see how much people are expecting the Fed to stay out in front of inflation and not provide the same kind of accommodation that they have in the past. And also just in terms of risk appetite, how much have we priced in, right? I mean, basically, if you get real yields continuing to climb, that continues to make triple leveraged all cash, you know, look good to some people who might like it.
The 2-year 30 spread. Wow.
Yeah.
Negative 41 basis points. I did not realize that, Lisa, how that's plunged.
Isn't that the greatest inversion going back decades?
I'll have to look at that. I failed. I didn't do my homework.
Welcome back, Tom.
Maybe I'll get it right by 2 p.m. this afternoon. Again, we are honored that Dr. Clarida will join us in the 2 p.m. hour. Stay with us. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Here we go again. It is Fed Decision Day, live from New York City. For our audience worldwide, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. It's over to you, Chair Powell.
We are expecting 75.
They're going to go ahead and hike 75 basis points.
75 basis points.
Another 75 basis point hike.
Chairman Powell has got one mission.
Stamp out inflation.
Deal with inflation.
We have the all-important Fed meeting.
The real question is
the terminal rate on the Fed funds.
That number is going up, of course. The Fed has come out more hawkish.
The reality is Powell is extremely hawkish.
There clearly isn't going to be a pivot anytime soon.
Chairman Powell put the kibosh on that at Jackson Hole.
They are feeling their way to how far they have to raise.
For right now, the Fed is kind of driving the ship.
It's certainly a recipe for further volatility.
Is joining us now, BlackRock's Kate Moore and Luke Cower of UBS. Kate, first to you. You heard it there, the echo of 75, 75, 75. Is that what you and the team are looking for a little bit later?
Yeah, it is, Jonathan. And I have to say, there is very little room, I think, for the Fed to sound dovish today during the meeting. The data is all suggesting they should continue on the path. I think the big surprise would be if they are even more hawkish than the hawkish expectations. And I think that wouldn't be received very well by risk assets, and particularly by equity markets. But if we had anything less than 75 basis points, there would be a lot of head scratching. I think we're all in that same camp.
How do you think they'll set us up for November, Kate, and the year ahead in the dot plot?
Look, I think less is more at this point, Jonathan. I think it's like, the less that they say about the exact expected path, the better off we're going to be. It'll be more data dependent, short and sweet, a la what Chair Powell gave us at Jackson Hole. Not making any commitments, but certainly not giving us any assurances that they're closer to a pause. I don't think they can make that assessment with the data that we have in front of us right now.
Looking at the risk for the investor at the moment, I asked the question earlier this morning, Kate, as to whether this equity market is just unbuyable. Lose-lose. Max Kettner of HSBC put this one out. I'd love your response to it. Hedge you, win tails, I lose. He said if growth continues to hold up, central banks will have to do more to slam the brakes, putting pressure on valuations. But if activity disappoints quickly, falling growth and earnings expectations will also be bad for risk assets. Is it a case of hedge you, win tails, I lose?
I mean, it's a case of, I think cash is the best asset class at this moment. And you know how much that pains me as someone who is an equity investor and who generally loves my asset class. But I agree, there are numerous different headwinds, whether it's around growth or policy tightening, geopolitics, sentiment, tax loss harvesting, you name it. There's a tremendous number of pressures, technical and fundamental, I think that we're going to face in the next couple months. Now, you can say, Kate, we may have a little bit of a relief rally at points, or we may see the equity market run a little bit from time to time, and that may be the case, but you have to be super tactical and really dynamic in your portfolio at this point, and wholesale adding to risk is not something I'm comfortable with.
And Kate, your team soft landing. That's what's amazing about this. I heard the same thing from Rick Reeder as well. You do think it's possible to engineer a soft landing, yet at this point, it's too early to even make the trade. So what are you waiting for, Kate?
I think we need more confirmation on the inflation side. I mean, one of the things that scared me a little bit from the CPI print was the breadth of the inflationary pressure. It wasn't just in services where we expected, but, many parts of goods as well. And I think we need to get another one or two inflation prints where we're showing, frankly, somewhat more moderate inflationary pressures and frankly, less breadth. So I'm watching that. I'm also really watching the lower end consumer. Credit card balances, how they're spending, any weakening in that part of the labor market. I think that would be, a signal that the Fed is sort of achieving some of its goal of taking some of the froth off. But
you know, it's really too soon at this point, and I think it's going to be really hard as companies start reporting third quarter earnings to give the same level of optimism and the same promising forward guidance they have in previous quarters.
25 minutes away from the opening bell, make it 26. Futures positive 0.5%, about 5 hours away from a Fed rate decision. Investors bracing for another big rate hike from Chairman Powell. Mike McKee is down in D.C. Morning, Mike.
Good morning, John. Yeah, and the question is how big a rate hike? That's probably going to be the easiest one to answer. They are likely to do 75 basis points this morning, as Kate and everybody else on your show has been saying, because 100 would maybe suggest things are worse than they look in the economy. The other question is how much higher and for how long? That's going to be a question that comes out of the dot plot, an answer rather. How high do they raise their forecast for the median dot in 2022, 23, 24, and we get 2025 today. So we'll see how long they intend to keep rates really high. Then what happens to unemployment? The summary of economic projections will give us their thoughts on where unemployment will be each year, and that should indicate how far they think they can go with unemployment before things are unacceptable. You'll also be looking at what happens to inflation. Does it go down more slowly than they've been talking about? There'll probably be a question or two about QT. But the inflation and unemployment numbers are going to be kind of key for trying to figure out where they go from here. You take a look at this chart here, which shows the Fed target rate, the unemployment rate, and the core inflation rate. Take a look on the right-hand side. How far does the blue line have to go up to bring the yellow line down? How much of those white bars have to rise? You can see the path that is already forecast ahead by Fed funds futures. And do they need to go higher than that? Because unemployment is coming down going up too slowly, put it that way. The other question is, what do they say about going forward with Fed funds futures? Look at this. The market still thinks they'll get to close to 4.5% and then start cutting rates right away by March of 2023. Jay Powell likely to tell them that's not going to happen. Interesting to see that after the decision and see if he's changed anybody's minds.
Mike McKee, thank you, sir. Looking forward to your leadership on the program a little bit later. The Fed Decides Surveillance Special, where we'll also be catching up with the former Vice Chair Richard Clarida on that program as well. Mike McKee will join us again a little bit later too. Chairman Powell of Jackson Hole, I went over that speech again yesterday evening, where he talked about pain repeatedly, said it a couple of times. This is what he had to say. Will higher interest rates, slower growth, and softer labour market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, he went on to say, but a failure to restore price stability would mean far greater pain. Luke Cow's with us now. Luke, can you tell me whether you expect the forecast from this Fed today to capture the pain that this chairman is talking about?
I think almost certainly you have to think about the forecasts as a messaging device that now are going to reinforce the very short message that Powell wanted to send at Jackson Hole. So when we think about the forecast, one thing we think they might show is effectively that the Fed right now wants us as market participants to believe in the idea of a reverse Evans rule. You know, the old one from the GFC, which was, no asset purchases continue until unemployment goes down enough or inflation gets high enough. That's effectively what the Fed is going to message in reverse. Something like, no, we're going to keep policy in restrictive territory and won't consider a turn until core inflation is below 2% or the unemployment rate is north of 4.5% or 5%. You can quibble about the thresholds there, but that's what they want market participants to believe. And then from asset allocation standpoint, where that leaves you is deciding, okay, will the Fed be right? Will the Fed get what it wants? On what timeline will it get what it wants? Or what events could possibly be blowing the Fed off course from achieving this?
Well, Luke, what is the appropriate time horizon to think about bringing inflation back towards target?
I think the Fed is going to be comfortable with a longer time of getting inflation down, as long as they're not in the protecting inflation expectations game, which, they no longer are relative to last meeting. Obviously, we've seen across the board kind of inflation expectations, whether survey-based, market-based, what have you, all of those have come down. If you're in that position where you're not worried about the kind of upward spiral there, you can afford to take longer in getting them down, and that's why it means higher for longer, and it's not this escalator to nowhere upwards in terms of rate hikes with no kind of terminal in sight. The Fed officials, particularly Williams and Brainard, have kind of laid out what they think constitutes a good idea of short-term neutral in real rate terms. And so, one thing that means is that if there are inflation upside surprises from here, as long as they're not kind of on an escalating fashion, you should probably see more of any move in yields to the upside probably be driven a little more by the break-even side than the real side, because reals are, more or less where the Fed wants them to be in order to engineer that kind of below-trend growth that over time contributes to lower inflationary pressures.
So, Luke, given where this Fed wants financial conditions to be, Kate Moore pointed out just moments ago that it's too early to add equity risk here, even if she's forecasting a soft landing. Do you share that view?
Yes, that's a view we share. We think that right now there's no real fat pitch across asset classes. There's nothing to really be overly aggressive about in rates, in credit, or in equities. The real action right now should be under the hood of markets, an intense focus on relative value. Even if you believe in the soft landing, because you have to have some humility here and think that we don't know what's going to happen in Q4 in terms of the potential for an energy price shock. We don't know if the U.S. economy is going to have more of a sudden stop dynamic in terms of how fast activity decelerates, and it's proven quite resilient so far. So in our view, the really appropriate thing to do is be focusing on trades that work in two of those scenarios, but are pricing in much more of the other, and really get some asymmetry there in across the board trades, and really be kind of working hard under the radar at those relative value bets.
Luke, Kate, sticking with us, I'm pleased to say. Great lineup going into the opening bell. Equity futures right now positive 0.5%. The dollar a whole lot stronger. Euro dollar negative 0.6%, 99.13. Sterling cable, the pound against the US dollar 113.42, negative 1/3%. That currency pair as low as 113.05 in the last couple of hours. Really interesting morning. Coming up on this program, Russia's Putin calling up 300,000 troops.
United Nations Charter and the ideals it represents are in jeopardy. We have a duty to act, and yet we are gridlocked in colossal global dysfunction.
That conversation up next.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Votes, referendums do not have any legitimacy, and therefore they don't change the nature of the conflict. This remains a war of aggression by Russia against the independent sovereign nation in Europe, Ukraine, and this will only further worsen the situation, and therefore we need to provide more support to Ukraine.
NATO Secretary General Jens Stoltenberg speaking to Bloomberg's Anne-Marie. Russia looking to tighten its grip on Ukraine, mobilizing 300,000 troops and threatening the use of nuclear weapons. The US ambassador to Ukraine tweeting the following: sham referenda and mobilization are signs of weakness, of Russian failure. The US will never recognize Russia's claim to purportedly annex Ukrainian territory. We will continue to stand with Ukraine for as long as it takes. This coming ahead of President Biden's speech at the United Nations General Assembly later today. Team coverage starts right now with Guy Johnson in London and AMH over at UN headquarters here in New York City. Guy, your thoughts on what we heard from Vladimir Putin overnight and this morning?
He's trying to change the calculus on the battlefield. He's trying to change the calculus for NATO and the West. He is saying that if we effectively annex and turn these parts of Ukraine into Russia, an attack on those parts of Ukraine are an attack on Russia. And that changes the calculus in his mind as to what comes next. Clearly, as we've just heard from the UN Secretary from the NATO Secretary General, that is not going to be the case. But it does change, I think, the perception in his mind of what comes next. The use of nuclear weapons obviously is the real wild card here. It's going to be interesting to see what the president says a little bit later on in his UN speech. Deterrence, how does the US use deterrence at this point to make that not happen? Clearly this is an escalation, but it's an escalation in a growing list of opportunities that Vladimir Putin has.
AMH, how do you expect the President of the United States to address some of these issues in New York today?
Well, his speech has just become all that more important because it's following, of course, on the heels of what Guy just outlined coming out of Russia. What the president is going to say, what we've heard him say a lot during this crisis, 7 months of this war, is that this is about being on the side of autocracies or democracies. And he's really going to push against those that coerce and intimidate their neighbors. And he's also going to try to push the UN to really strengthen their core tenets. You have a member of the Security Council, Russia, that is infringing on another country's sovereignty. This is the message the president will be bringing to New York today. And it comes at a time as well, John, we should also note, of course, if Putin is talking about do not call my bluff, if you want to use nuclear weapons, the wind also turns the other way. We heard from John Kirby of the National Security Council, their spokesperson, today on Good Morning America, and he said at this moment, there is no need to change the United States strategic posture, force posture. But obviously, this is something that they have laser eyes on.
AMH, looking forward to your coverage a little bit later through the day here in New York. Guy, I've got to throw this one at you. Did you see the Deutsche Bank forecast on European growth now? Guy, GDP for 2023, they've got it at negative 2.2%, down from negative 0.3. The ECB has got it nowhere near that right now.
The ECB continues to play catch-up, doesn't it, as to what is the reality on the ground. And I think, John, you've just spoken to that. There are serious concerns about what is happening with the European economy. It is going to be a very difficult winter. What we've just been speaking about is only going to exacerbate that risk. And as a result of which, yeah, I think forecasts are going to continue to be downgraded, and the ECB is going to continue to have to play catch-up. How it responds is going to be really interesting. It's going to be an interesting question as well for the Bank of England, John. Are you worried about inflation, or are you worried about the recession risk? Because that is going to condition your response to the situation in front of you. Is the Bank of England going to go 75 on Thursday, or is it going to go 50, or potentially even less? But 75 and 50 look to be on the table.
Are we worried about the currency? Euro dollar 99.10, sterling 113. Guy, looking forward to the programme in about 43 minutes' time. I'll pick up on that Deutsche Bank quote again for you. Lisa shared it with all of you a little bit earlier. Here's the quote. We're revising the Eurozone GDP forecast for 23 from negative 0.3% to negative 2.2%. I want to bring in Luke Carr and Kate Moore to talk about this. Luke, your thoughts on that call from Deutsche Bank and just how the ECB is nowhere to be seen on the recession front right now?
Well, I think first off, it's reflective of one thing that we're all trying to do in examining whether there is value or not in European assets. Is right now that's a fog. It's a fog that's very difficult to look through because so many elements of this are effectively up in the air and not even under the control possibly of policymakers. When it comes to the ECB, where this gets into more interesting territory is, we do have forward guidance effectively from Lagarde that you can used to make bets and expectations about what's going to play out in markets. But on the duration side, the central banks that still have the capacity really to inject a lot of interest rate volatility into the long end are probably the ECB, the BOE, the BOJ. That's where it's coming from if you get more of it. And just as markets were pretty much ahead of central banks in front-running how bad inflation was going to be and the needed response, markets are also going to be front-running central banks on the response. Yep. We haven't quite gotten there in a decisive way, and that's something we're looking at kind of across the board in terms of what it means for when to pivot more constructively on duration, when to be kind of adjusting currency exposures. Things like that are what we're looking for, and again, just not in a case where that's decisively there yet.
It's the dollar piece of this I wanted to pick up on with Kate Moore. Kate, the dollar index is strongest since 2002. Euro dollar at 99, sterling at 113. How are you thinking about the dollar when it comes to the equity market at the moment?
Yeah, I mean, the dollar strength was one of the less discussed takeaways of the second quarter earnings season. A number of companies did mention it. It had an impact, of course, on their overall bottom line. I think the persistent strength in the dollar is going to be something we really have to focus on in the third quarter as we go through reporting season and going forward. Our expectation at this point is that the dollar remains pretty well bid, that the monetary policy differential, the growth differentials, we're talking about U.S. versus Europe, are going to continue to support the dollar strength. That said, do we see the same level of appreciation we've seen in recent quarters? I don't think so. But the other side of this, too, of the strong dollar is the weaker euro. And on balance, that would help parts of the European equity market, those companies that are, exporters that are serving, a geographically diverse set of customers. The challenge, of course, is if a weaker euro is happening at the same time you see massive degradation in domestic or at least continental demand, it's not a great picture. So despite, what should be a currency tailwind for earnings in Europe, I'm not particularly excited about investing in European equities.
Okay, what about the translation from Europe back to the United States? It's a two-punch combo. In many ways, it comes down to the currency, obviously, and the translation effect from euros back to dollars, one, but also, two, it's the underlying weakness in the economy that's leading towards the weakness in the currency. So it's another punch there. You get a lower top line, lower bottom line, and then you get the translation effect, which has less bite. Kate, what does that mean for the big cap versus small cap conundrum, that question dilemma here in America?
Yeah, look, I think a lot of people have been looking at European equities and saying, has sentiment gotten bombed out? Is there potential for outperformance? And I don't think you see that happen unless we get a really constructive outlook for the banks. And sure, higher rates are good for the banks and for net interest margins, but then you have the massive headwind, which is the deteriorating demand. When it comes to kind of large versus small in the U.S., John, as you're asking, it's going to be a tough one. Look, large companies in general have better ability to weather higher interest rate environments. They tend to have more bargaining power with their suppliers and with, the companies in their overall ecosystem. Most of them have more, diverse sales and diverse business lines, so they can dial up and dial down different parts of their business in a more challenging economic environment. Smaller companies don't have that flexibility, and smaller companies, by and large, are facing the worst labor pressures. So, I still very much prefer large caps over small in the U.S. as long as you're staying invested. But then you have to look within each industry and say which company actually has the better platform, even, say, in the large cap space.
Kay Moore, Luke Cower, both on the same page. Too early to add equity risks right now into this Fed and out the other side. Thank you, guys. Appreciate it, as always. Futures up 0.5%. Coming up, the morning calls and later, PIMCO's Tiffany Wilding looking for big changes to the Fed's economic projections. She'll join us around the opening bell in just a moment. From New York, if you were looking for the former Bank of England Governor Mark Carney, who was due to join us around 9:30, we had promoted that a few times. Unfortunately, he has cancelled that interview. We're going to look to rearrange that in the near future. From New York, this is Bloomberg.
the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
5 minutes away from the opening, Bell Equity Futures positive 0.5%. Here are your morning calls. First up, Mizuho. Downgrading Micron to neutral, $56 price target, seeing a challenging landscape with weakening demand out of Europe and China. Bank of America adding PayPal to its list of best investment ideas, expecting shares to outperform after shedding 50% of its market cap this year. And finally, Barclays downgrading Cisco to equal weight, $46 price target, saying the company appears vulnerable to the macro environment. That stock is down by a little more than 1%. Coming up, we're counting down to a Fed rate decision. We'll get a preview with the absolutely brilliant PIMCO's Tiffany Wilding. We'll do that in just a moment, with futures positive 0.5%. The dollar stronger, with euro dollar just about clinging on to 99, and sterling at 113.43. The cash open up next.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keene and Lisa Abrambitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
The big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
20 seconds away from the opening bell, live in New York. Good morning to you. Here's the price action. Equities firmer by 0.5% on the S&P, on the Nasdaq up around 0.4%. A bounce going into another Fed decision. What is it about Fed decision days and market rallies? Not a secret anymore, is it? Let's see how this one works out later on this afternoon. There's the opening bell. Switch on the board and get to the bond market. 8 consecutive weeks of 10-year yields climbing. They fall back today, down by 2 basis points. 353.97 on a 10-year. Your 2-year. Think about where we've been over the last year. 21 basis points 12 months ago. At the start of the year, 76. At the start of the quarter, 283. At the start of the month, 349. And right now, 396. That is a massive change. And that is what has taken this dollar another leg higher, stronger. Euro dollar, negative 0.6%, 99.12 on euro dollar. Crude up by 2% and change, 85.69. That's the cross-asset price action. 40 seconds into this one. Let's get you some movers. Here's Abby.
Well, John, we do have yields down, as you were just pointing out. Not in a huge way, but yields down means stocks up, a real reversal of what we saw yesterday and what we've been really seeing recently and even on the year. Tech in particular liking this. Valuation becomes more attractive. Not hurting banks, though, interestingly enough. Bank of America up about 0.5%, so it's a broad-based rally at this point. Energy, the top sector at this point, Southwestern Energy, a Texas E&P company, up about 3%, outperforming. They produce and explore for both gas and oil. Gas right now up about 3%, oil up about 2%, as you were just showing. And then finally, General Mills, they put up a very strong fiscal first quarter. They, of course, are the maker of cereals, also Betty Crocker and Haagen-Dazs, among other brands. They beat, they raised. Their profit view is now looking for growth of 2 to 5%, better than what had been expected. Very interestingly, John, it's on higher prices, so even though sales not quite as strong and gross margins getting hurt by higher input costs, they've been able to raise prices enough to offset some of that weakness.
Abby, thank you. About 2 minutes into this one, we advanced 0.6%. Top of the pile, energy names up by 1.1%. Every single industry group on my screen right now in the green. Communication services names up around about 0.2%. Another rate hike expected at 2 p.m. Eastern time. Kelly Lyons has more. Hey, Kaylee.
Hey, John, will that rate hike mean another market rally off the back of it? Because that is the pattern we have seen taking shape in recent meetings. Yes, we are pretty much on the downslope coming into today, even if we are bouncing today. The S&P 500 over the last 6 days was down a little more than 6%. The NASDAQ 100 down about 7%. But we've seen that before. In January, March, and June, for example, you saw stocks dropping sharply in the run-up to the decision, but then they rose between 6 and 9% in the days following. And actually, since hiking began in March, the average decision day rally for the S&P is about 2.3%. It has actually risen after 8 of the last 10 decisions over the past 18 months. So if history is any guide, markets may be well due for a bounce here. And maybe that's because the Fed hiking in and of itself isn't necessarily a bad thing for stocks. In theory, the Fed hiking is because the economy can take it. And my wonderful producer, Dan Curtis, actually went back to crunch the numbers and look at the previous hiking cycles we have seen the past few. Stocks actually rallied up 8.5% between 99 and 2000, 12% between 04 and 06, and in the most recent cycle ended in 2018, stocks were up nearly 23%. Of course, this time around, it's been a different story. The S&P down about 9.5% since March. You could argue, John, that this is unlike any cycle we have seen before because we're coming out of a recession, unlike anything we ever had. So we'll have to wait and see ultimately what the fate is for equities, John.
Kelly, thank you. Looking forward to this afternoon. I keep talking about this. The Fed decision. Going into it, we'll have Scott Minerd around the desk with us. Coming out of it, we'll be catching up with the former Vice Chair Richard Clarida, Diane Swanker, KPMG, with us as well. We'll also hear from Matt Lazzetti at Deutsche Bank, Priya Misra of TD. Matt Lazzetti has got a 5% call now on Fed funds for next year. Just south of 5% on Fed funds for next year. That's a monster call from Matt Lazzetti. Priya Misra has been dead on 2s, 10s. Months ago, she was looking for negative 40 basis points. We went through that level, so looking forward to that conversation. Then out the other side of the news conference, Clara is going to stick with us to break down the decision, and I believe we catch up with Jeff Rosenberg of BlackRock as well. So looking forward to that. Equities at the moment, about 4 minutes into the session, we are advancing just a little bit, up 0.4%. PIMCO's Tiffany Wilding expecting big revisions from the Fed this afternoon. She writes the following: we expect Fed officials to formalize Jackson Hole with significant hawkish changes. We look for a significant increase in median dots, cuts to begin in 24, upward revisions to inflation forecasts, downgrade to the economic outlook. Tiffany joins us now. Tiffany, it's good to catch up. Let's start with the dot plot. What are you looking for specifically in the dot plot through the end of this year into next year and beyond?
Yeah, well, thanks for having me, Jonathan. I mean, I would characterize the changes as mounting misery for the Federal Reserve. Of course, I'm referencing the Arthur Oken Index from the 1960s, where he added unemployment and inflation together. You know, I would say overall, for the median path for the interest rate hikes, we think that you're probably going to see some big upward revisions, as you suggested. I think 75 basis points addition we could see for the end of this year. So that would imply, you know, kind of 4 to 4.25 on the Fed funds, you know, for the Fed funds rate. And then next year as well, we'll also see some upward revisions. So similar sized upward revisions that get the median path closer to 4.5. So that implies, you know, some pulling forward of rate hikes as well as raising the terminal rate. You know, and outside of that, I think this is going to be coupled with revisions to the economic outlook that are worse for growth, higher for unemployment, and of course higher for inflation. You know, so again, this is really mounting misery for the Fed. I think they really understand that they are solely focused on inflation. They need to get the real Fed funds rate, which is what really matters, above neutral levels. You know, and that's going to result in additional rate hikes.
Well, let's talk about where the pain lies in the labour market. Unemployment, their forecast, as you know, Tiffany, and I'll share this with our audience, 3.7% is the forecast year end, 3.9 23, 4.1 2024. At 2 p.m. Eastern time, Tiffany, what do you think those numbers are going to look like?
Yeah, I mean, I think the unemployment rate is going to move higher. So I think the question is what does their longer-term unemployment rate forecast do as well? You know, so we think that could move higher. I don't want to get too wonky, but I think there are reasons to believe that there's higher surge frictions in the labor market, which just means that like that kind of underlying level of unemployment that's more neutral will also rise. That Federal Reserve has that at 4% now. You know, their estimates, the San Francisco Fed put the estimate of that closer to 6%. So it just suggests that the unemployment rate rise needed to bring down inflation is much more than maybe what is currently penciled into the SEP. So unemployment rate rise in terms of their forecasts, you know, could be to 4.5 or maybe even a little bit higher. You know, in addition, that could be, you could also see that longer run unemployment rate tick up as well.
Well, Tiffany, where do you think Nauru is? How do we know anyway, but what do you think it is?
Yeah, I mean, it's obviously very uncertain, you know, and it's easier to, you know, to estimate the past relative to what it is now. We had obviously a very big economic shock with the pandemic. I think there has been some reallocation to the economy as a result of that and to the workforce, and it is creating additional surge frictions. You know, I would not be surprised if we see that 5% is more consistent with, you know, the underlying neutral level of unemployment. You know, but of course, as I mentioned, the Federal Reserve Bank of San Francisco recently put out a paper that suggested that you could even be as high as 6%. You know, so that's well above where we are right now in the labor market, you know, suggesting that is still very tight, and the Fed has a lot of work to do to really cool the economy off here.
So higher Nauru and then ultimately higher terminal to really do something about unemployment and to get inflation down. I asked this of Luke Carr a little bit earlier, Tiffany. I'd love your view on it as well. Do we have to rethink about the time frame that's going to be needed here to get inflation back to target?
Yeah, I think you do. That's a really good point. You know, so certainly, you know, I think you're going to get upward revisions to inflation, particularly core inflation. But these aren't necessarily upward revisions for this year. You know, I think their forecast for this year looks okay, but what to me looks increasingly too low is the forecast for core PCE inflation in 2023 and maybe even out to 2024. I would argue that since the June SEP round, inflation is just looking much stickier. And that's not, that's not only looking at just, how inflation has evolved, CPI or PCE, but it's also looking at a range of the surveys for longer-term inflation expectations, most notably the survey of professional forecasters that the Philly Fed puts out. They've been ticking up, and that's notable because that survey tends to have very low volatility. Professional forecasters usually think inflation is just going to be right at the central bank target of 2%. That's been ticking up, which is very concerning. And I would also just say that this broadening in inflation is not just a U.S. phenomenon. It's happening in other developed markets as well. And of course, just the last point here is that wage inflation has also accelerated. And the Atlanta Fed measure, for example, it looks more consistent with nonlinear effects in the Phillips curve, so that you could see wage inflation even rising more from here. And all of these trends, I would say the Fed is probably not happy with.
So how much lower do you think growth needs to be then to achieve all of the above?
Yeah, so ultimately, we don't think the Fed will be forecasting a recession, but we think it's increasingly likely that you probably do need some contraction in real GDP to really get the unemployment rate up to a level that's more consistent with inflation falling down. I guess the question in terms of recession in the U.S. is how deep. I think some contraction is likely. The depth of the contraction needed, though, is we still think it's relatively shallow because we don't see a lot of economic imbalances when we look across the economy. Consumer balance sheets, on average, are still pretty strong. But nevertheless, I think it's becoming more clear that you do need some contraction in the economy in order to get inflation back down.
And Tiffany, short and shallow is the consensus. You lent on shallow. What about short?
No, so we actually think that it's going to be a more prolonged period of contraction relative to what you've seen recently. When I say recently, I mean the pandemic. So we saw this very V-shaped recovery after a very deep recession, the pandemic, and that V-shaped recovery was because of the policy reaction to the weakness. So obviously a very big fiscal response, very big response from the Federal Reserve as well. Because inflation is running so high these days, you're not going to see that type of fiscal response or monetary policy response. We think the Fed is going to be much more delayed in sort of accommodating weakness. So that just means that you get shallow but potentially a longer period of contraction, and even after that contraction stops, we would argue you're probably going to see a more prolonged period of just very sluggish below trend growth that's going to come about. So this is not more akin to something like an L relative to a V.
I'm collecting questions for Mike McKee for the news conference later. Tiffany, just a final question. What's your question for Chairman Powell right now?
Yeah, I think it has to get to this idea that inflation is stickier. And so is the Federal Reserve, given its dual mandate, are they really prepared to deal with some economic contraction in order to bring inflation down? Again, their SEP projections suggest that they still think they can to get a soft landing, but I think that maybe there's a plausible path to that, but that plausibility is declining as we get more onerous news on the inflation side.
Tiffany Wilding, just fantastic, brilliant, as always. It's good to catch up. It's been too long. Don't be a stranger. Tiffany Wilding there of PIMCO. From the West Coast, waking up super, super early and looking ahead to the Fed. I'll repeat what Nick Benenbrook of Wells Fargo said earlier this week to Lisa and I on Bloomberg Surveillance. Like landing a jumbo jet on a picnic blanket. That's how tough this is going to be in the minds of so many people. Coming up, markets on edge with investors gearing up for a Fed rate hike.
Corporate profit margins are still pretty good, and they put in place 2 years of ultra-low-cost financing in 2020 and 2021, and you've got a tight labor market. I think the Fed's watching all of this, and I think it's going to cause them to have to go further than even we think in hiking rates to really lean into this kind of growth.
The conversation continues. Up next.
person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
We're saying wait until we get into a recession. A reasonable spread level for recession is 750 basis points. We think at a minimum, the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
Okay, pause. Those calls from Bob Michael at JP Morgan Asset Management. He's talking about the prospect of 5% on Fed funds, 4.5% on treasuries, 750 on high yield spreads. Right now, spreads are 483 at the close yesterday. So we've got some work to do here, a lot of work, 267 basis points worth of work. And he's effectively saying, wait, it's too premature to jump in, be patient. We've got work to do. Wait for the recession is the call now from Bob Michael. And I can tell you, that's a change of call from where Bob Michael was only just 3 months ago. About 17 minutes into this one, equities up 0.6% on the S&P, on the Nasdaq up 0.4%. Big Wednesday for markets. Bank CEOs testifying on Capitol Hill. The president speaking at the UN General Assembly, both within the next hour, and later a Fed rate decision and Chairman Powell news conference. Kaylee has more for you. Hey, Kaylee.
Hey, John, it's like we took everyone that financial markets will drop everything and listen to and threw them all into the same day, or at least us here in financial media. The president of the United States, the executives from these big banks, and the chairman of the Federal Reserve. As you said, first up are the banks on Capitol Hill. What do they have to say about the health of the economy and the consumer? That really is going to be the language that the markets grip to. Then President Biden will talk geopolitics shortly thereafter. And then, of course, we're going to get not just a rate decision, but the updated dot plot and summary of economic projections at 2 p.m., followed by Chairman Powell at the podium. So all of that would have been more than enough excitement for a Wednesday, but Vladimir Putin this morning decided to throw a little bit of geopolitical risk into the cocktail with his remarks on the mobilization of reservists, talking about using any means necessary in Ukraine, which raises the threat at least of potentially nuclear weapons, or the question of it. All of that being market moving, giving a lift to commodities, giving a lift to some of those defense stocks here in the U.S. and also a little bit of a haven bid coming into treasuries. But of course, it's usually selling treasuries these days, not buying them. We have seen monster moves to the upside in the treasury market in anticipation of an aggressive Federal Reserve. Just take a look at the short end. The two-year yield up 323 basis points year to date, and more than 100 basis points of that has come just since the start of August. We are very, very close to 4%, meaning the curve is more inverted, negative 40 basis points at this point between 2s and 10s. That inverted yield curve, what it signals about the health of the economy, to bring it back to the banks, probably something they're going to be talking about today, John.
Kelly, nice. Thank you. On the yield curve as well. I mentioned it earlier if you missed it. TD's pre-MISRA coming up a little bit later. Absolutely fantastic on that. Kelly, thank you. And to Kelly's point, if you have a day where the defense names and energy is rallying at the same time, often something good isn't happening somewhere, and I think we can say that's true of today. A little bit later, big bank CEOs testifying before Congress, executives preparing to deliver lawmakers a warning about the economic risks of surging inflation. Shonali Basak, of course, on top of this story. Hey, Shonali.
John, we already have some hints of what they're going to say because we do have the testimonies, and Citigroup's Jane Fraser is saying that the economic outlook is daunting despite getting over the worst of COVID. You also have heard from Jamie Dimon, we talked about it yesterday, that idea that this is a tale of two cities, and he's also worried about more in terms of capital requirements for the banks coming at a time where the economy is tightening. But let's talk a little bit about that tightening, because even with that tightening and lawmakers really worried about the cost of borrowing rising for consumers, for homeowners, for small businesses, at the very same time, you really don't have those savings rates rising very meaningfully along the back of higher interest rates. So if you take a look at what the FDIC tells you, you're getting 17 basis points. And if you're getting a 60-month CD, you are still getting less than 1 percentage point back. So again, banks are flush with cash, just sitting on more than $6.3 trillion worth of excess liquidity, and there's still a lot of worries about, how they start to boost lending at a time when the economy gets tougher and not really raise savings rates at the same time. They will face questions about what they are doing right now for society as the whole economic outlook starts to change.
Shonali, where's Mr. Solomon?
It's a good question, because on one hand, we're also going to be looking for a question about a lot of social issues as the banks face. There's not a lot of investment banking executives there. There's no James Gorman. There's no David Solomon. You do have the big consumer banks, which shows you that, at least for this week, what they're really concerned is about the bank branches, the networks across America, and getting that money into the hands of Americans.
I ask this because there are some concerns about his consumer operation, right?
Yeah, it's still so small compared to the rest of them. And I have to say something interesting. If you look at what's happening at the other banks and what they're being asked of, the prepared testimonies, they're also commenting on social issues that still apply to Morgan Stanley and Goldman Sachs, which is that issue of diversity and what they're doing for minority communities across the country. So again, Morgan Stanley and Goldman Sachs both not there on the Hill today and tomorrow, but to your point, will face questions moving forward from the Federal Reserve and other regulators.
Shonali loves this stuff.
I do.
If this was side by side with Chairman Powell, I'd be watching Chairman Powell, and Shonali would not even be looking over to see what was happening. I know that for a fact. Shonali, thank you. Looking forward to it later on the breakdown tomorrow, of course, on the latest with the CEO bank hearings, the bank CEO hearings, rather, a little bit later this morning. Let's get you some sector price action. Stocks are up 0.6% with a breakdown. Here's Abby.
John, we are looking at a gain for the S&P 500, the other indexes right now. It's coming on very weak volume, though, 20% below the 20-day average. So stocks, investors still treading water ahead of the big decision. Now, the top sectors, some of them are up about 1%, industrials, consumer staples, and utilities. The latter two, they, of course, are high dividend yielding sectors and stocks. So the fact that you have yields down a little bit today makes those dividends look a little bit more attractive. Now, let's take a look at the sector breakdown, though. Since the last Fed meeting back in July, most sectors are down. 8 are down. The two sectors higher, not surprisingly, energy and then utilities. That's really interesting because, of course, yields have just blasted higher, which would make those dividends look less appealing, but that, of course, as you know, John, is a defensive sector, so it's doing well. That speaks to the sign of the times. Tech and communication services, mega cap tech, not so much as those yields do climb, John.
Abby, thank you. Coming up next on this program, your trading diary from New York. This is Bloomberg.
stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I believe they'll do 75, but I cannot fully rule out 100. I can rule out 50. There is no justification for dialing back at this point. But I really think the highest probability is 75.
That's one to chew over. The former Atlanta Fed President Dennis Lockhart there in the last 24 hours. Equities up 0.6% on the S&P, and the Nasdaq up 1/3%. That's the price action. Here's your trading diary. What you need to be watching. Coming up, existing home sales and US bank executives testifying on Capitol Hill. That's up at the top of the hour. President Biden addressing the UN General Assembly at 10:30 Eastern. We get a rate decision at 2 p.m. Chairman Powell news conference 30 minutes later, followed by a rate decision from the BOJ and BOE on Thursday, and closing out the week with US PMIs on Friday. Looking forward to the Fed special a little bit later with the surveillance team. The Fed decides. We'll kick things off at 1:30 p.m. Eastern time. You will hear from the chairman. You'll hear from the former vice chair, Richard Clarida, immediately after the decision. From New York, this is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi and so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?